Hello, all the CA inter students. Now, this is a time to make a super quick revision of the theory in financial management. So, FM concept, generally people think that only the practical questions will come in examination, and that is not completely true. In the total 50 marks of FM, including choice, it comes for the 60 marks, obviously. In that 60, 50 will be practical, but 10 marks to 12 marks will be a theory area. So in that 12 marks theory area, what are the things that can come? 12 is generally happening. 12 to 13 also sometimes coming, 13, 14 like that. So you should be well prepared for 3 theory questions in your exam. How many? 3. See, how they will ask questions in exam, let me show you. First one, there are 3 important theory areas. In the 2 are extremely important. One is the types of financing. A 6 marks question will come. They can ask a 4 marks and 2 marks, or 2 3 marks, or directly one 6 marks question. Okay, generally how they are asking is 4 marks and 2 marks. They are asking 2 questions in that particular area, types of financing. Next, scope and objectives of financial management. They are asking for, actually this is coming for 4 marks and this is coming for 3 marks. So this is how they are testing. 3 means 2 to 3 marks. Totally 12 marks theory will be there in your paper. Okay. From this, what you need to understand, SM paper will be completely a theory area. FM paper will be 90% practical and 10% theoretical. If you observe clearly in the overall paper number 6, theory will be here 50 marks, here another 12 marks, 62 marks theory will be dominating here. From this, what you need to understand, 120 marks paper, 60 marks will be theory. Means what? Half the paper is a theory, half the paper is only practical in this particular area. So, you should not be allergic towards a theory with regard to paper number 6. SM inevitable anyway you have to study. Okay, but FM, though it is having a theory that is very easy to absorb, easy to understand as well. So today I am going to help you in covering out the most important theoretical areas such that your 12 marks will be 1000% guaranteed if you listen to the lecture completely. Because if you don't listen to lecture completely, I can't give that guarantee. But if you listen to the lecture properly now, I will make a super quick revision of the entire theory in your syllabus. If you properly follow that, 1000% is a 12 on 12 you will get, because questions will come directly from the book. Okay, just it's an observation. Anyway, this is not like some economics, or it is not like law. To have a legal point, we need to write as it is. You can write in your own words as well. What you need to understand, concept you need to know. Okay, we are going to concentrate on that. Obviously, from the marks point of view, what is most important, I am going in the same sequence. First, I will cover the types of financing area. Okay. Next, I will cover scope and objectives of financial management. Next, other theory chapters also will come. Cost of capital, 3-4 theory questions. Capital structure law, 3-4 theory questions. Ratios analysis law, 2-3 theory questions. Like that, all the chapters have small theory areas. We will cover everything, and we will cover 100% entire theory that is applicable for your exams. Clear? So, let us first focus on the types of financing chapter. See here. First one, I'm going in the same sequence. Whenever sequence I wanted to change, I will tell you well in advance. For example, we are going to cover question 1, 2, 3. Suddenly I may change the sequence at a later stage. At that time, I will only tell which question sequence we need to follow. You follow with my sequence, have this theory book with you, and continue. Question number 1. Explain the importance of trade credit and accruals as a source of working capital. What is the cost of these sources? Listen, first I will explain. Trade credit means credit purchases made by a company. I am a buyer, credit purchaser. I made a credit purchase. Because of that, what is the greatest advantage that I will get? Here, two people are there, buyer, seller. Seller is selling goods on credit. Buyer is buying goods on credit. We need to tell the answer from both the person's point of view. Okay, wow? So first, let us discuss from the buyer point of view. Buyer point of view. For me, it's a creditor. For me, yes, is a creditor. That's called as a trade credit. Why it is called as a trade credit? Because yes, did not give me loan of money. He has given goods to me. Therefore, we don't call it a financial creditor. We call them as a trade creditors, because they are called as trade creditors because they are helping me in doing my trade. Okay, number one. Number two, see here, I will give you an example. I wanted to purchase goods. How I can purchase? I can take loan from bank and buy the goods, or directly you can purchase goods on credit. Directly you can purchase goods on credit. But when you take loan, you have to pay interest on that. But when you take goods on credit, interest need not be paid. Therefore, this is a cheapest source, almost negligible cost involved in the source of financing through trade creditors. Trade credit means what? Buy the goods now, pay later. Buy goods now and pay later. Means what? Zero business also you can do. Means what? Zero debt business. What do you mean zero debt business? I will start a company today. I will purchase goods on credit. I am confident that I can sell the goods definitely in 1 month time. Therefore, I will purchase goods on 1 month credit. I will purchase. I will sell them. 1 month I sold. I purchased it on credit at 100 rupee. I sold for 150 rupee. With zero investment, I made a 50 rupee profit or not. And from nothing, I created something. That is possible only in case of trade creditor. But if you take loan from bank, from nothing you did not do the business. From something you have done, and for something you got something as a return. But trade credit is a magic always. Okay, so therefore, who will use trade credit? Mostly small scale industries will be there. Now, banks don't give the loans to them. Okay, banks don't give loans to them. Then how to do the business? Trade credit is the major source of financing when it comes to a small scale industry. They're heavily dependent on trade credit. So trade credit and accruals are a source of working capital. Okay, what do you mean by working capital? Working capital is a short-term capital. Creditors, when you take goods on credit, now you have to pay after 5 years. 1 month, 2 months, you have to pay. It's a short-term requirement. Refers to credit facility given by supplier of goods in the normal course of trade. It is a short-term source of finance. So point 1, point 2. Small-scale industry firms are heavily dependent on this source of financing for their working capital needs. Point number 3. Okay, major advantage is easy availability. Everyone will give goods on credit. Flexibility. Whenever you want to buy, you can buy. Whenever you wanted to pay, you can pay within that 1 month time. And informality. What do you mean informality? Bank loan, if you want to go, procedure will create headache. You will be irritated such that you will stop taking the loan itself. Documentation, stamp papers, legalization, almost so many things will be there. Very much formal. And it is governed by RBI rules as well. Loan taking by any person. But trade credit, there is no formal procedures involved. Go buy the goods on credit, that's it, answer over. It is more informal. So availability, flexibility, informality are the advantages of trade credit. Point number 4. Next one. Now let us see from the supplier point of view. Now we saw from the buyer point of view. Now we are going to discuss about supplier. Why? For the supplier, it is a cost. See, generally what people think is, what suppliers generally think is, trade credit, if you give, nothing will happen. It is a zero cost to us. Okay, no cost of capital. But try to understand. I am a supplier, you are a buyer. I spoke about you till now. Now I am talking about me. I have goods. I will purchase from someone. I purchased at 100 rupees. I purchased at 100 rupees from some person. And I sold goods to you on credit. Okay, I sold goods to you on credit. Means what? I purchased goods from someone. My capital is blocked. I sold to you. You will pay me after 1 month. Means for 1 month time, my capital is blocked or not. On that, there is an opportunity cost or not. If I would have invested that money in a bank for 1 month, I will get interest. That all is a loss to me. Therefore, there can be an agreement that trade credit is cost free, but it is not true. Point number 5. It involves implicit cost. The supplier extending trade credit incur cost in the form of opportunity cost of funds invested. Point number 6. Okay. So now, last point. So supplier will always bear a loss. Whenever there is a concept of trade credit, buyer is at an advantage, supplier is at a disadvantage. Okay, now why supplier will take disadvantage? That's why whatever the opportunity cost of capital they are losing because of giving credit, all that cost, they will add it to the price of the goods. At the end of the day, the fool is you and me, being consumers. That's what he also said. Supplier passes on this cost to the buyer by increasing the price of the goods or by not giving discounts. Okay, 1 point completed. Question number 1 over. Read question number 1 and answer. Pause the video and see. Okay, next. What do you understand by spontaneous sources of finance? Explain its source. See, sir, what is spontaneous source of finance? Spontaneous source of finance means in the ordinary course of trade, spontaneously credit should come. What is the example? Trade credit. That's it. Answer over. Trade credit is called as a spontaneous source of finance. Means what? In the course of doing the business, I will get that financing. See, I wanted to I am a dealer in mobile phones. Yeah, I am a dealer in mobile phones. I will buy mobile phones. I will sell mobile phones. I wanted to buy an iPhone. Okay, I will buy on credit. I will buy on credit from you for 1,10,000. I will sell to a person at 1,15,000. 5,000 rupee profit I made without putting any investment. Why? Your business is that spontaneously credit is created. So this is the concept of spontaneous source of finance. Okay. So it refers to financing arising out of regular day-to-day operation. This you need to write in exam. Okay. This question came for 5 marks already so many times. And first one, it arises in the regular and day-to-day course of trade. Spontaneous sources of finance includes all those sources that are available upon demand or that naturally arises as a part of doing the business. Point number 2. Point number 3 is example, trade credit and accounts payable. Next. Discuss risk return consideration in financing of current assets. Read the question first. The next one. Discuss the risk return considerations in financing current assets. Already we read the question. So what is this concept? Let me explain first. Point number 1. What is good for a company? Short-term financing is good or long-term financing is good? That's the question. So there is always a dispute, a trade-off between, okay, a short-term and a long-term financing. Point number 1. Okay. So first one, if a firm can choose from short-term or long-term source of financing. So there are two sources of finance. One is short-term, another one is long-term. What is the advantage of short-term financing? Lower cost of capital. For example, if you take trade credit, it's a short-term finance. Okay, trade credit. What is the cost involved? Almost zero cost. Buyer point of view, if you see, you will buy today and you will sell, you will pay later. So you are not charged any interest on that. Na? Credit period itself means no interest. Almost zero cost. Or if you go to a bank and take a short-term loan, rate of interest will be 9.5, 10% like that. But if you go for a bigger commercial loans, 17, 18% is there. So what is the problem here? Short-term finances always have lower cost. So less expensive than long-term finance. So point number 1, there is always a dispute, trade-off between, okay, trade-off between risk and return. Risk and return, a relationship exists. So firm can choose from two sources, short-term and long-term. Point 2. Point 3, short-term finance is a less expensive source of financing. But at the same time, short-term financing involves greater risk than long-term financing. Why, sir? Why short-term financing is more riskier than long-term financing? Listen carefully. Short-term finance will become more risky than long-term if you do not use it for a purpose in a proper way. Sir, I did not understand. What is this purpose? Listen carefully. I will give you an example. I wanted to purchase a house. House is a long-term asset or short-term asset? Long-term asset. I want to purchase a building. I'm not a real estate person to buy and sell. Okay, I'm a normal businessman. I wanted to purchase a building worth 5 crore. Okay, building is held by me, expected to held by me for 25 years. Maybe after 25 years, if I get a very good value, I may sell. But normally, I will hold it for 25 years, guarantee. Kandipa, I will be holding it for 25 years. Means it's a long-term investment for me or a short-term investment? Long-term. That long-term investment, if you purchase out of short-term financing, that's all. Your business is gone. Listen, I will give you an example. I wanted to purchase a house property worth 5 crore. Okay. I wanted to purchase that out of a 6 months loan, short-term finance. Short-term finance. Now, I took a loan of 5 crore short-term. I purchased a house for 25 years. Now, 6 months after, bank will come to me and tell, Kaushik Mukesh, pay me 5 crore. Pay me 5 crore. How can I pay 5 crore? I have only 2 options now. What is the first option? First option is, I have to sell that house and pay him 5 crore. Correct? Then why you invested? Why you invested? 6 months only you have to pay. So, second thing, whatever the cash you are having in the business, you have to take it out and you have to pay. In that case, your business will be in trouble. That's the problem. So, what is the point here? The purpose for which you are using the short term tells whether it is a risky or not risky. Short term finance used for short term assets na super combination. Long term finance can be used for long term assets or sometimes for a short term assets. So what you have to understand, asset finance short term use only for short term assets. Long term finance use it for long term or sometimes even short term is also okay. Are you understanding? That's what you want to tell in this point. Depending on the mix of short term and long term financing, approach should be followed by the company. Okay. In matching approach, long term finance is used to finance fixed assets and permanent current assets, means long term. And short term financing is used to finance a temporary or variable current assets. That's what he wanted to tell. Okay. A firm finances permanent assets and also a part of temporary current assets with long term finance. That's why I said long term finance can be used to buy either long term assets or to some extent short term assets as well. That's what I said here. Okay. But short term finance use it only for short term assets. So okay, that's the point you need to write here. For the 4 marks, you need to write these points in exam. Next one. Question number 4. What is the concept? Explain the term plowing back of profits. Explain the term what? Plowing back of profit. So what is this concept of plowing back of profits? Let's see. Okay. What is plowing back of profits? Whenever company wanted to make any long-term investment, always you need not go for bank financing. Sometimes bank financing means you have to pay interest. Sometimes company can also plow back the reserves and surplus and make investment. We saw in various models, na? Walter model, Gardner model. Gardner model, what is the logic? G equal to B into R, correct? What is B? Retention. R is return on investment. What does it mean? Whenever you are having any retention of profits, invest somewhere such that it will give you extra return. Growth will be there. So plowing back of profits is compulsory for public limited companies. Okay. So long-term funds may also be provided by accumulating the profits of the company. So plowing back of profits means taking out the profits and investing in the business and plowing them back into the business. Okay. Next, such funds belong to the shareholders and increase the net worth of the company. Increase the net worth of the company. Why it will increase the net worth? Reserves and surplus means bank account there is a cash of 5 crore. I will invest that 5 crore in a project. Bank if you put, you will get savings bank interest of 2% to 3%. Current account 0 interest. But the moment you put the same amount in a project, that will give you 15-20% return. Thereby the net worth of the company will grow. So whenever you plow back the profits and make investment, it will increase the net worth of the company. So what is the first point? Long-term finance can be made also by accumulated profits of the company and plowing back into the business. Point number 1, 1 mark. Next one. It belongs to shareholders and plowing back of profits and investment will increase the net worth of the company. Point 2. Okay. A public limited company must plow back a reasonable amount of its profits each year, keeping in view the legal requirements in this regard and its own expansion plan. So whenever expansion plans are there, always do not go for financing outside. First try to bring your own profits and make investment. Okay. Such funds also entail almost no risk because bank, if you take the finance, you have to pay interest, which is risky. But when you take out accumulated profits, on accumulated profits, you need not pay interest to anyone. Almost there is no risk. Further, most important thing is, if you plow back the profits and make investment, I wanted to invest in a project. I have only 2 options, 3 options: bank loan, public offer of shares. Third one is plowing back of profit. Plowing back of profits has no cost involved. Correct? No cost involved because I am taking my own money that is available. So there is no risk. Number 2, whenever you go by plowing back of profits and not going by public offer, there is no dilution of ownership of the existing equity shareholders. Control of the present owners is not diluted by retaining the profits. Okay. So 4 points you need to write in order to get that 4 marks in exam. Okay, well, 1 minute time I will give. Please read the definition of that particular concept clearly. Okay, plowing back of profits. Read properly, please. Okay, well, next one. Next one. Advantages of raising funds by issuing of equity shares. Super question, yeah. Very, very easy answer, but listen carefully. See, I will give you some advantages of equity capital generally. Okay, generally. First one, point number one, equity is a long-term finance. It will be there in the company till winding up. Okay, till winding up. Therefore, there is no redemption. There is no redemption. Preference shares, if you issue, you have an obligation to repay back. Debentures you issue, you have an obligation to repay back. Equity shares, if you issue, there is no concept of redemption until winding up of the company, or if company goes for buyback. Normally, what equity share, he will sell in the market and get the money. So, company is not having the liquidity problem. Understood the point? And there is no liability to pay. There is no liability to pay except on winding up. So, permanent source, not redeemable, and no liability on the redemption. Okay, number one over. Next, number two. Whenever you issue more equity, more borrowing powers you are getting. Equity la borrowing powers. Sir, equity is a owner's capital, na sir. I did not say that. Listen to my language first. Okay. Whenever the equity shares are issued, more equity capital comes into business, borrowing powers will increase. Why? Listen. Company can maintain a debt equity ratio of not exceeding 1 is to 2. What do you mean by that? Sorry, very sorry. 2 is to 1. What do you mean by that? What do you mean by 2 is to 1? For every 1 rupee equity, you can have 2 rupee debt. Okay. So if I have 100 rupee equity, you can have 200 debt. Okay. Borrowing. You can make 200 borrowing. If I have 200 equity, you can make 400 debt. And what is increasing? Whenever the equity share capital is increasing the finance base, your borrowing powers is also simultaneously increasing. So equity capital increases company's financial base and also the borrowing powers. And moreover, if you wanted to tell me from company's point of view, also I can give a reference. Deposits chapter, we will read one section called as section 180, subsection 1, class C. Do you know what they say? To borrow money, proposed borrowing, where money borrowed, together with the money already borrowed. See, to borrow money, where the money to be borrowed, proposed, together with plus money already borrowed, existing borrowing, should, if it exceeds paid up share capital, free reserves and securities premium, special resolution is required. They will tell like this in 181C. From this, what you understand? Special resolution is required only if this LHS exceeds RHS. Correct? See, paid up share capital, in that equity capital will be there. If it is 100, if it is increasing, automatically your borrowing power is also increasing on LHS side. So like that also you can understand. So in simple language, what you have to understand, whenever there is a concept of equity issue, equity will not just increase the equity financial base, it will also increase the borrowing powers. That is second advantage. Third, very, very important advantage. If I take loan from bank, interest is compulsory. If I issue preference shares, dividend is compulsory. But company is not obliged legally to pay dividend on what? Equity shares. Okay. That means in case of uncertainty or if the company is not performing well, dividend payments can be reduced or even suspended, because dividend payment is not mandatory. Clear or not, everyone? Okay. Next, whenever you issue equity shares, the greatest advantage is further issue becomes more easy in the form of right shares. Okay. That's it. Take a minute time, read the answer properly. Okay, everyone completed? I hope you completed this. Next one. Financing through borrowing is cheaper than equity. Cheaper than equity. Briefly explain. This is the question they are asking. Okay. Let's also see this. Okay. Everyone, can I continue? Yeah. See here. Financing a business through borrowing is cheaper than equity. Okay. Listen. Is it really true? It is true, but not fully. Whatever the extent it is true, we are going to read now. Okay. See how it will be cheaper. Listen. First point number one. KDKE. KDKE. If you compare in any question, KD is always a cheaper source. KE is always a costlier source. Cost of capital chapter n number of times I might have repeated already. Which is more costly? KE is costly. KD is cheaper. Why KD is cheaper? Because borrowing always there is a fixed payment. When fixed payment is there, certainty is there. When more certainty is there, lesser risk is there. When low risk is there, low returns will be paid. So for the company, from the company point of view, raising debt will be always cheaper than raising equity, because equity shareholders will not get a fixed return in the form of dividend. Dividend may come, may not come. So there is always a risk involved. When uncertainty is there, risk is there. When risk is there, more return will be asked by them. Okay. Debt ki fixed return will be there, but equity will always change their mind according to the circumstances in the market. So taking all these points into consideration, debt is always cheaper than equity share capital in terms of cost of capital. Another greatest reason that everyone has to understand debt is always cheaper than equity means tax advantage will come. Whenever you pay interest on debt, interest comes to P&L debit. P&L debit, if it comes, automatically it is a deductible expense. So to that extent, income tax saving you are getting, correct? But dividends will be paid after profits are computed. Means already taxes are paid. There is no tax advantage. So those points you need to write in exam. See, debt capital is cheaper than equity from the point of view that its cost and interest being deductible for income tax purpose. Okay, cost means the interest part, whereas no deduction is allowed for dividend, because dividend is paid after computing profits. Interest will be calculated to compute the profits. Next, another way, from the cost point of view, he said, from the control point of view, we will discuss now. Whenever you take more debentures, nothing will happen. Okay, control will not be diluted. Those are people are only just lenders. But whenever you issue new equity, there is a dilution of control. Okay, next. In a period of rising prices, borrowing is advantage. Borrowing is advantage. A fixed monetary outgo decreases in real terms as the price level increases. Sir, I did not understand the third point. How to remember for exam? Concept, if you remember, point you will remember. Okay. See, I will give you an example. See, whenever in the market, purchase prices are increasing. See, I can sell a product at 100. Cost is 60. Profit 40. Okay, profit 40. Fixed cost, interest cost, a fixed cost. Let us say, for example, fixed cost is 20. What is my profit? 20. What is my profit here? 20. Next. So 100. Sorry. Now listen. Next year, this is year 1. Year 2, what happened is prices are rising. Purchase prices, not the sale prices. I can sell only at 100. 60 became 70. 60 became 70. So it became how much? 30. 20 will not be increased now. Just because of the reason that cost has increased, fixed cost don't increase, interest cost don't increase. That will be same 20, it will be 10. So 20 became 10, correct or not? If 20 also increase, they will be in trouble. Fixed cost being interest cost, the most greatest advantage is in the period of rising prices, borrowing is advantageous. The fixed monetary outgo decreases in real terms as the price level increases. As your cost is increasing, fixed cost being interest will be sometimes advantageous for you. Okay, done. Next one. Discuss the advantages of preference share capital. Okay, let's complete. First thing, point number 1. Equity share capital will be diluting the EPS because number of shares though you will divide. Correct or not? Okay. So advantage of issuing preference shares. No dilution of EPS on enlarged capital base. Okay. No dilution of EPS. Okay. Next. There is no risk of takeover as preference shares do not have voting rights. Simply to tell, preference shareholders do not control the company. They don't take over the management or control because preference shares don't have voting rights. Okay. Next. They are leveraging advantage as they bear fixed charge. What does it mean? Leverages chapter already we have done n number of times. There I already explained. Whenever preference shares are issued, okay, preference shares are issued, you are going to pay a fixed dividend and you are going to pay a fixed principal on maturity date. That's it. Correct? So what will happen? Whether profits are increasing or not, we will pay only a fixed dividend. Therefore, an advantage will come. For example, my profit is 1000 rupee. Preference shares ki dividend is 100 rupee. 900 is my profit. Next year profit increased to 1200. Even then I will pay that 100 rupees only to them. Correct? So therefore, there is a leveraging advantage as it bears a fixed charge. Preference dividends are fixed or pre-decided. Preference shareholders do not participate in the surplus profit as ordinary shareholders. Ordinary shareholders will take the share in profits at the end of the year, but preference shareholders don't share the profits. Profit will come up first, they will be paid, balance will be shared by the equity shareholders. Next, preference shareholders can be redeemed after a specified period. Read the answer carefully. Okay, va? So next one. List out the conditions framed by SEBI which company needs to fulfill to issue bonus shares. Companies Act, okay. SEBI also released guidelines on issue of bonus shares. Simply, bonus shares under Companies Act section 63, what they say, you can issue bonus shares out of three things: free reserves, securities premium, or CRR, capital redemption reserve account. Free reserve, what will come? What will be coming in that free reserve concept? Into that free reserve, okay, free reserve, securities premium, CRR. Balance in P&L account also will be coming under the free reserve for SEBI guideline purpose. And redemption of debentures key will create sinking fund at DRR. In that DRR we pay debentures. Okay. Even after that some amount is still remaining. That can also be used. That's it. Over. That's the answer. Company may make bonus shares. So fully paid a bonus shares from what are the sources? Companies Act first. Free reserve, securities premium, and CRR. Along with that credit account of P&L. P&L account credit balance. That's only called as a balance in P&L account. Next one, sinking fund. Sinking fund. There will be a fund called as a DRF, debenture redemption fund. From the debenture redemption fund also you can redeem. Okay, you can issue bonus shares. Okay, I created debenture redemption reserve or debenture redemption fund. Let us say, for example, I created worth 100 crore or 110 crore. Debenture redemption is only 100 crore. Then what will happen? Balance 10 crore is excess is there na, that can be used for issue of bonus shares because it's a free reserve, excess over the payment. Next. Debt securitization, I will discuss about this separately. Okay, I will discuss about it separately. Okay. I told now whenever I change the sequence, I will let you know. Yeah. From here, I am going to cover now. Again, I will come back. Every question in the book, every question in the syllabus we will cover. Sequence, I am telling you. So first around 8 questions we covered. Now we are coming to question number 22. See, from here to some question number 22 till the end we will cover. Okay. First, let us cover these issues from question number 22. First, explain the features of commercial paper. First, let me tell about what is this commercial paper. Okay. First point number 1. Commercial paper question comes in exam. 4 important things you need to write in the answer or else they don't give the marks. First, very important thing. Commercial paper is a debt instrument by a company and a company has raised a debt. It's a liability to company. Number 1. So it's a debt instrument. Which one? Commercial paper. It is an unsecured debt instrument. Means there is no security on that. It's an unsecured instrument. Since it is unsecured, there is high risk to the investors or not. Company issue commercial paper, but the investor is at a higher risk now because it is unsecured. Therefore, since risk is involved, we need to know how good the company's character is. Which character? Credit character, payment character. Means, is this company prompt in making the payment or saying something and doing another thing? Are they prompt in paying their payables, or they will say something and pay later? Are they willful defaulters, or they are having a proven standing in making the payments? So therefore, credit rating has to be obtained. What should be obtained? Credit rating. What I said, 3 points I said. First one, commercial paper is a debt instrument. It is an unsecured instrument. Since it is unsecured, there is a high risk. Therefore, from credit rating agencies, we need to get credit rated. Companies having a very good credit rating only can issue commercial paper. 3 point. Fourth point. Okay, fourth very, very important point. Since it is an unsecured instrument, this will come under the RBI guidelines. This will come under RBI guidelines. Means who will be the caretaker? RBI. 4 point. Fifth point. Life of commercial paper starts with 7 days, ends with 1 year. Means maturity period of a commercial paper cannot be more than 1 year. Therefore, this is a short-term financing. Answer over. And the answer over. See now. Commercial paper is a unsecured. Point number 1. Money market instrument, means debt instrument. Commercial paper is an unsecured borrowing. It is governed by RBI. Next one. It can be issued only by highly rated corporate borrowers. It's a short-term borrowing. Why short-term? Because maturity will be between 7 days to maximum up to 1 year. Okay, it is not the only source of short-term financing. Additional short-term financing, there are so many things. Trade credits are there, accruals are there, or short-term borrowing from banks is there. Commercial paper is also there. Okay, this is not the only, this is an additional instrument. Okay, commercial paper ki par value will be not in hundreds and thousands, it will be in lakhs. That's why it can be issued in denominations of 5 lakhs or multiples thereof. Means what? 5 lakh, 10 lakh, one commercial paper 10 lakh, one commercial paper 50 lakh, like that. 7 lakh, 6 lakhs they can't issue, because it should be either 5 lakh or multiples of 5 lakh. All eligible issuers should get credit rating from credit rating agencies. That's it. 5 points you need to remember here. That's it. You will get that full marks. Next. Who can issue the commercial paper? Eligibility criteria. Let us read. First one. Tangible net worth. Net worth means what? Net worth can be computed in 2 ways. Liability side, asset side. Liability side, it is nothing but equity share capital plus resource and surplus. Okay. Asset side, if you take total assets minus outside liability. When you take this total assets, you should not consider intangible assets. You should consider only tangible assets. That's the meaning of tangible net worth of the company. Is 5 crore or more. Next one. Working capital not less than 5 crore. First one is what? First one is a tangible net worth should be minimum 5 crore. Okay. Next, working capital limit also should be minimum 5 crore. So 2 things should be minimum 5 crore. What is that? Tangible net worth and the working capital. Working capital limit. 2. Next one. Credit rating must be obtained from credit rating agencies like CRISIL, ICRA, etc. Next. Credit rating at the time of applying to RBI. Okay. And not more than 2 months old. Means what? You have to get the credit rating done, and within 2 months of getting credit rating, RBI approval also should come. Means what? If the gap between credit rating done and the RBI application is more than 2 months, you cannot issue commercial paper. And last 2 years back, you will get the credit rating. On that basis, you can't go for commercial paper issue now. Maximum validity period of that credit rating will be 2 months. Next one. Current ratio means current assets to current liabilities ratio should be 1.33:1. Means what? That company issuing the commercial paper should not have current ratio more than 1.33:1. Means what? 100 rupee if there is current liability, current asset should be 133 rupees on the asset side. Then only you can go for commercial paper issue. Okay. Next. Sixth one. Public sector companies, there are no listing requirement, but for companies other than public sector, same should be listed. Simply, what do you mean by that? Companies who wanted to issue commercial paper should be listed companies only. Exemption is given to whom? Public sector companies, government companies, all these things are there. For them, exemption. For normal companies other than public sector companies, must and should, you should be listed in order to go for commercial paper. Next one. All issue expenses shall be borne by company issuing the commercial paper. During the course of issuing the commercial paper, there are so many stamping fees, legal expenses, registration, all these. That company only should bear. What does it mean? If I raise money, you should raise money from that only. You should put all expenses. For example, company issued commercial paper worth 100. Okay. In this 100, expenses are 5. 95 you can use in the business. Like this you should do. You should not do like this. 100 rupee I will raise, 5 rupee towards expenses also I will raise, totally 105. No, not valid. Company only should bear the cost of issuing the commercial paper. Understood? 7 points, 7 golden points. Start. Tangible net worth should be 5 crores or more. Minimum working capital limit should be 5 crores or more. Obtain a credit rating. Credit rating should not be more than 2 months old. Current ratio should be 1.33:1 minimum. Public sector companies ki no problem, but normal other companies ki listing is mandatory. And final one is issue expenses should be borne by the company, should not be taken from the investor. That's it. Eligibility criteria for commercial paper completed. Next one, deep discounting bond. Already questions we have done this in cost of capital if you are my student. See, deep discounting bonds, zero coupon bonds work in the same way. They are issued at a discount, redeemed at par. Issued at a discount, redeemed at par. Problems you can see cost of capital chapter. Deep discounting bonds are the form of zero coupon bonds. These bonds are sold at a discounting value. Sold means what? Issued. Sold means issued at discount. Okay, next one. On maturity means on maturity. Face value is paid. Means what? Par value is paid. Okay. No interest will be paid during the period. Next. Zero coupon. Zero coupon bond does not carry any interest, but it is sold by the company at a discount. Difference between discounted value and the maturity value is the interest. For example, I will issue at 1000, redeem at 5000 after 10 years. A balance of 4000 interest paid. Separately, they don't pay any interest. I will take from you 1000, I will give you 5000. A balance of 4000, you put whatever name you want. Means the return that you get is 4000. So, the issue, this is a redemption. Okay, done. With this, we completed another three concepts. First, 4 concepts: commercial paper, conditions to issue commercial paper, eligibility, deep discount bond, zero coupon bond. Okay. So with this, we completed another set of 4 questions. So next one. So we completed deep discount bond, we completed zero coupon bond. Next one is the masala bond. Sir, what is this masala bond, sir? Simple. Listen carefully. Masala bond name came from Indian point of view. Why they kept that name, I will tell you. If I issue debentures in India, I will issue in rupee. If I issue debentures in USA, I will issue in dollar. But masala bonds are those bonds which are issued in a foreign country but in Indian denomination. Means what? The issue will be made not in dollars, issue will be made in rupees. Redemption you do in any currency, but original denomination of that particular bond will be in rupee. So those are called as the masala bonds. That's it. Masala bonds is an Indian name used for rupee denominated bond that Indian corporate borrowers sell, means issue to investors in overseas market. So Indian companies issue to overseas investor. Okay, what bonds? Rupee denominated bonds. When you issue in USA, you should issue in dollar, but these bonds are issued in rupee directly. Okay, so these bonds are issued outside India but denominated in Indian rupee. Example, NTPC raised 2000 crore via masala bonds for capital expenditure in the year 2016. One example they have given. Next one. Hey, there are 2 types of bonds here. Yankee bonds, YANKEE, and BD bonds. Okay. What is Yankee bonds? What is BD? BD bonds means bulldog bonds. Sir, what are these all names? Are nonsense. See, bulldog is a name which came from UK, for which British bulldog is very popular there. So as a token of remembrance, British bulldog, a national icon of England. Okay. So that's why the name came. Point number 1. So it is named after national icon of England, British bulldog. There is a dog in a bulldog, British bulldog. As a token of the national icon of England, they kept that name as bulldog bond. But what is this bulldog bond? Listen. I will write here in a summary. Please listen first. Okay, ma? See. non-British company issue to, okay, non-British company issue to British investors in their currency. Indian company issuing bonds to company in UK. For example, there is a company called as X Limited in UK. Y Limited company in India. Y Limited is a Indian company. X Limited is a British company. This Indian company issuing pound denominated bonds to them. Pound is their currency, na? These are called as bulldog bonds, BD bonds. So a bulldog bond is a type of a foreign bond issued by non-British corporation. That's why we will say that it is other than the British corporation. Okay. Next, seeking to raise capital in pounds, in pound sterling. Pounds are also called as pound sterling from British investor. Okay. So in our example, we have taken Indian business company. It can be anything, but example I have taken Indian. So non-British company issuing to British investor in their currency, pound sterling bonds, those are called as the bulldog bonds. It is traded in UK, which is purchased by buyers interested to earn revenue stream from British pound. So it is purchased not by Indians, it is purchased by the buyers in United Kingdom. Next one. These foreign pound denominated bonds are referred as bulldog bonds because British bulldog is a national icon of England. 3 points you have to write in exam. Number one. Okay, number one. It is a foreign bond issued by non-British corporations to the British investors in pounds. Number one. Number two. It will be invested. Okay, who will purchase the bonds if you issue? Persons resident, the buyers in that particular United Kingdom only will buy. Okay, and the last and final one, this is called as a bulldog bond as a national icon of England is British bulldog. Okay, next. Sir, what is Yankee bond? Same concept, in replace USA with UK. Okay, replace USA in place of UK. These bonds are issued by non-US banks to a non-US corporation in US. Okay, what is this bond is called and what are the other features of this bond? It is not completely like bulldog bond, similar to that of, that's why I said put this US in place of UK. Now I will tell what are the differences between that. Okay, first listen. This bond is called as a Yankee bond. This bond is called as Yankee bond. Listen carefully, I will tell you. X Limited is incorporated in India. Okay, incorporated in India. Okay, next. Y Limited. What is this? Y Limited. Y Limited is a South American company. South American company. Okay. Now, these people, which is a company incorporated in South America, they wanted to raise money from USA. See here. These bonds are issued by non-US banks. Let us say X Limited is a bank in India, non-US bank, and non-US corporations in USA, non-US corporations in USA. Sorry. For your understanding, I will give you super example. Yeah, listen. See, I will give one example such that all doubts will be cleared in one stretch. See here. Yankee bonds, how they work. Remember the example, that's it. All points you can frame and write in the exam. See, Yankee bond. Non-US company or a bank making issue of bonds for the US investors. For the US investors. In India, SEBI is there, na? Like that, USA is SEC, Securities Exchange Commission. These should be SEC registered. Bonds are issued in USA. And these bonds should be in dollar. Previous example, what is the example? Non-British company, British investor, pound, BD bond. Same concept. Non-US company to the US investor, denominated in dollars. Okay. And SEC registration is mandatory. Okay, securitization is mandatory. Okay, now you have to remember at least 5 points. I will tick. Bonds are denominated in dollar. Condition 1 satisfied. I'm ticking here also. Please see. Okay. Bonds are issued by non-US banks or and US corporation. Yes, non-US bank or corporation. Bonds are issued in USA. Yes, they are issued in USA. Registered in SEC. Registered in SEC. Okay. Next one. Bonds are issued in trenches. Trenches means all the bonds they will not issue once. Segments. First they will issue what, for example, I want 1 billion. They will not issue entire 1 billion. They will issue first 1 billion means 100 crores, 10 crore, 10 crore, 10 crore, like that in trenches they will issue. Okay, that is not that important. Time taken can be 14 weeks. Means the life of this particular bonds can be 14 weeks. Next, interest rate is dollar libar. Sir, dollar libar, remember, what is this dollar libar? Finally, we will have a complete discussion. Libar means London Interbank Offer Rate. London Interbank Offer Rate. It is not normal banking, savings bank interest, current account interest, that type. This is like a stock market share price. It changes every single day. That's called as a libar rate. So interest will be paid on this. Interest will be paid at libar. Which rate? Libar rates. Okay. With this, we completed Yankee bonds as well. Next one. Next one. Euro convertible bond. What is it? Euro convertible bond. Okay. Let's begin. Mark it important for the exam. For the examination, most important one is the Euro convertible bond. Okay. 8 points they will expect you to write for 5 marks. First, I will tell you what is a Euro convertible bond. First, let us understand the nature. The word Euro is there now. Because of that, people think that like pounds, like dollars, euros, they will pay. No, dollars say, US dollars say. Name came as a European style they issued. That's why name came as a Euro convertible. Okay. First point number 1. Let me first explain. This is called as a quasi debt instrument. Point number 1. Okay. Point 1. I am writing points here. 1. Example, first what you need to write? Euro convertible bonds are quasi debt instrument or quasi debt security. Quasi means not completely, semi. It's not completely debt. It's not completely equity. It's a semi debt equity type because it's convertible, convertible to shares. Okay. Which can be converted into shares. Okay. This is point 1 you have to write. Very good. Next. After that, point 2. It will offer the investor an option to convert the bond into equity at a fixed price after a particular time period. So second point also similar to that. So first one, Euro convertible bond is a quasi debt securities which gives us an option of conversion into shares. This Euro convertible bonds offer the investor to convert the bond into equity at a fixed price after some period of time. Okay, 2 points over. Point number 3. This point you need to write. The bonds carry a fixed rate of interest. Means what? Euro convertible bonds are issued by Indian companies in USA. Indian companies in USA or elsewhere. Even if you issue in Britain also, you need to pay only in dollars. Indian companies are issuing Euro convertible bonds. Correct? Correct. Now, we issued bonds means we have a debt obligation to pay. So what we need to pay? Fixed interest you need to pay. Okay. Next. Now let us think from the investor point of view. Okay. Listen carefully. You issued Euro convertible bonds. Okay. Euro convertible bonds. Bonds will be converted into shares on maturity date. Correct? Okay. Let us say, example I am telling. 1 euro convertible bond equal to 1 share. Generally, 1 euro convertible bond equal to 7 shares, 10 shares, like that they will give multiples. Example I am taking. 1 euro convertible bond will be converted into 1 share on maturity date. Okay. Now, you are having 2 situations. See, euro convertible bond, market price is $100. Okay, $100. Means if you redeem with the company, 100 rupees you will get par value. If you convert into share, it is $110, or this is $100, this is $90. What does it mean? See here, I will give you two situations. I will give you how many? Two situations. I am an Indian company, issued euro convertible bonds. Someone invested outside India, invested. He is now having a bond with him. Lock-in period is completed. Okay. Now he has two options. What he can do? Number one, he can redeem with the company. He can redeem with the company and get that $100 he paid. Bonds, normally what we will do, 5 years bonds, principal will be invested. Every year interest. Your principal will again come back in the end of 50 year. Like that euro convertible bonds also, Indian company issued euro convertible bond. Indian company issued a euro convertible bond. That euro convertible bond issued by an Indian company, after some lock-in period, investors outside India either can do two things. They will tell company, take the bond and give my money back. At that time, $100 will come. Or you have an option to convert. Option to convert means what? You will put that particular euro convertible bond and you will ask the company. Means you will call the company and tell, I want share for that, because share price is 110. Means with $100 bond, I can acquire a $110 share or not. So I'm getting a $10 extra or not. Therefore, I will call the company and ask the company, give me share. For example, if it is 90, then getting 100 rupees from the company is better. Na? Therefore, what you will do? Put the bond there, euro convertible bond, and take your 90. That's how the name came as call option and put option. Call option allow company to force conversion if the market price exceeds a particular percentage over conversion. Means if the market price of the share is exceeding a number, it is better to convert that and get that benefit. Na? Therefore, we call it a call option. Put option means what? Allow investor to get his money back before maturity. Okay. Means he will put that and tell the company, give my money back. Company will give you. So there are two options. One is call option and the one is put option. Point number 4. Call option will allow you to convert the bond into share at the market price prevailing. Put option will allow you to take your money back before maturity. Next one. In case of this euro convertible bond, payment of interest and redemption will be made by the issuer company. Let us say it's an Indian company in dollars. Okay. Euro convertible bonds are listed at London and Luxembourg. London and Luxembourg are in Europe. That's why they call euro convertible bonds. Next. All the other things, main points completed. So how many points we covered? 5 points. Point number 1. Euro convertible bonds are quasi-debt securities which gives an option to convert into shares. Second one, it will give an option to the investor to convert the bonds into equity at a fixed price after a particular minimum lock period is completed. Okay. Next one, after that, it will carry a fixed interest. Next one, there are two options. Number 1, call option. Number 2, put option. Call option means investor will be given a chance to convert that particular euro convertible bond into some number of shares at a market price. Okay. If the market price of that particular share is exceeding the value of the convertible bond, then better to go with share because wealth is more there. Okay. Next, put option will enable him to get back his money before the maturity. Next one. After that, it will be interest and redemption will be paid by the issuer company in US dollar. They are listed on London and Luxembourg stock exchanges. Next. Up to here, 5 points complete. Another 3 points we need to write. An issuing company desirous of raising ECBC is required to obtain prior permission of Department of Economic Affairs, Ministry of Finance, Government of India. Okay. So permissions required. Whose permission is required? Department of Economic Affairs, Ministry of Finance, Government of India. And company, I can't start today and immediately I can't go for convertible. Company is having 3 years of good track record will only be permitted. Means minimum 3 years you need to wait in order to go for euro convertible bond. Sorry, I am an Indian company. I have a very good track record in last 10 years, not just 3. I took the permission of the Department of Economic Affairs, Ministry of Finance, Government of India. I fulfilled all the terms and conditions. Can I issue? Yes, you can issue. But once you issue euro convertible bond, you will get money. For what purpose you can use? 4 purposes only they have given you. First, import of capital goods means what? Money came. You can use it for importing any capital goods from outside India. Number 2, already you have a lot of foreign currency debt. You clear that foreign currency debt with this. Third, if you wanted to start joint ventures outside India, For that investment purposes you can use. Next one, 25% of the total money raised can be used for working capital and general corporate restructuring or general corporate purposes. Okay, sixth point, 7 point. 7 points you have to write in exam here. Okay, seventh, eighth, 8 points. Okay, first 5 points understood now. Next one is what? That particular company issuing ECB should obtain the prior approval of Department of Economic Affairs, Ministry of Finance, Government of India. Number 1, it should have a minimum track record of 3 years. Okay. Number 7, and last one, it should be used only for import of capital goods or repayment or retiring the old foreign currency bonds. Next one, establishing any joint venture abroad, and 25% can be used for working capital and general corporate purposes, paying salaries or whatever, generally. And 75% should be used only for import of capital goods or retiring foreign currency debts and Indian joint ventures abroad. That's it. Only 25% can be used towards working capital and general corporate purposes. That's it. Mark this very, 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 very important. Every chance is there, this can come in the exam. Okay. Next, floating rate bonds. Name lone clear. Floating rate bonds. Normally, whenever you issue bonds, interest is a fixed rate. Means whether market law, whatever happens, fixed rate. But sometimes company wanted to hedge the risk. Hedge means cover the risk. Okay, they are exposed to risk. Now, for example, I'm a company. I issued bonds at interest rate of 9.5%. Okay, because at that time, normally banks are offering 9.5%. Therefore, I also announced at 9.5. After issue 5 years bond, second year after, interest rate fell to 8%. And if I would have issued after 2 years, I should pay only 8%. But now I have to pay 9.5. Whether or not it is 8. These kind of problems generally companies will face. Therefore, some companies will issue floating rate bonds. Means what? Name no clear. Rate will float. Whenever market rate increases, I will pay that. Market rate decreases, I will pay that. So let's see. These are the bonds where interest rate is not fixed. As I said, na, interest rate will not be fixed. It will be floating. As per the market interest rate, we will also change it. And is allowed to float depending on the market conditions. Okay. These are ideal instruments which can be restored by the issuers to hedge themselves. Hedge means covering the risk. Interest increases, we will also pay interest on par with the market. If interest reduces, we will take that benefit. Okay. They have become more popular as money market instruments. Simple question only. Next. Briefly explain the features of external commercial borrowing. Listen. External commercial borrowings means name lone clear. India entity is there. They wanted to borrow. Okay. From external source for commercial purposes. So realigned as external commercial borrowings. Okay. So from whom we can raise external commercial borrowings? Okay. From whom we can raise? India company is there that will raise the ECB. From whom? Who will purchase there or who will give the loans there? International banks, capital markets outside India, multilateral financial institution. Means what? That financial institution is not for any one country. Different countries give one financial institution. See, State Bank of India, it's a bank in India. Canara Bank, it's a bank in India. But Asian Development Bank, it is a bank for entire Asia. Multi countries can use that bank. Those things are export credit agencies, foreign collaborators, foreign equity holders, like that. Anyone can do it. Okay. So this question was not tested anywhere before because that's a very small question. Just you need to remember, external commercial borrowings is the borrowing, means loans taken from non-resident lenders. Okay. Who are they? Any 5 names you remember. International banks, capital markets, multilateral financial institution, foreign collaborators, foreign equity holders. At least remember this. Okay. Next one. Name various financial instruments dealt within the international market. Okay. So financial instrument dealt in the international market. Different types. Whatever you read till now in our syllabus. Euro bonds, euro convertible bond, foreign bonds. Okay. Just now we read na floating rate bonds. Just now we read na external commercial. Like that, there are 2 things in CA final. Currency options, currency futures. Okay. Currency options, currency futures. Euro commercial papers. Euro commercial papers. Euro convertible bonds we saw like that. Euro commercial papers are also there. Euro commercial papers. At least remember 1, 2, 3, 4, 5, 6. What are those? I am writing here. I am separating. 3 marks question this is. 6 points you need to write. Euro bonds. Other than Europe, remaining foreign bonds. Okay, va? Next one. External commercial borrowings. Next one. Foreign currency options. Foreign currency futures. External commercial papers. 6 points you need to remember. Next. Now, next one. This one again here. Question number 33, 34, 35, 36, 33, 34, 35, 36. One question you can expect in exam. Entire concept 33 to 36, there is only one concept. What is it? Concept of lease. Concept of what? Lease. Okay. Lease la there are two types. One is operating lease, another one is a finance lease. Okay. Let us first see the differences between both of them. Finance lease means you are the lessor, purchased the asset. I am the lessee, taking the asset for lease. Normally, what will happen? You are the owner of the asset, you will claim depreciation. Correct? I will not claim depreciation, but that depends on the agreement between two people. Means what? You are a lessor, I am a lessee. Normally, lessor will be the owner, lessee will be the person who is taking that on rent. But finance lease, there is a great thing that happens. If the asset life is 10 years, 90% of the life of asset will be in the hands of lessee only. Means what? Substantial life of the asset will be in the hands of lessee. Therefore, agreement sometimes what they will write, do you know? You are the lessor, I am the lessee. I will pay you lease rentals every year. Okay, 9 years out of 10 years or 10 out of 10 years, I will only hold it. Okay, what? Agreement they will enter. What agreement? Depreciation, lessee will claim. Depreciation, lessee will claim. Then who will get the depreciation? Owner, though he purchased the asset, lessee only will claim the depreciation. Okay. Sometimes if no agreement is there, lessor only will claim depreciation. This concept we call tax oriented lease. Remember, example, they will definitely ask the question this time. Tax oriented lease. What is the tax oriented lease? A lease agreement where depreciation on the asset will be claimed by the lessor. Whenever depreciation is claimed, what will happen? It comes in P&L. Tax saving will come. Technically, it is a cash inflow because of savings of payment of tax because of depreciation debited to P&L. Correct? So, if the tax benefit on depreciation is taken by lessor, we call it a tax oriented lease. Okay, if the benefit of depreciation is not taken by lessor but is taken by lessee by agreement, we don't call it as a tax oriented lease. Okay, what said? So what is the first difference between finance lease and operating lease? In case of finance lease, risk reward on the asset will be passed on to the lessee. In operating lease, it is with the lessor. See, risk and reward to ownership are passed on to lessee. Lessor only remains the legal owner of the asset. Okay, so who is the legal owner? Lessor. But who is the beneficial owner? Lessee. But in operating lease, lessee is only provided to use the asset for some time. That's all. Asset ownership and everything will be belonging to lessor. Next one. Lessee bears the risk of obsolescence. Lessee bears the risk of obsolescence. Means asset is the damage. Repair should be done by lessee only. But here, lessor will take care. Next. Lease is non-cancelable by either party under it. Means what? Once a finance lease is entered, you cannot cancel it. Okay. But operating lease can be cancelable by the lessor. Next. Lessor do not bear the cost of repairs, maintenance, etc. I told that. So here lessor only will bear. Next. Lease is usually fully paid out. Means what? Complete value of the asset, lessee only will have. Okay. Lease is usually non-payout. Non-payout means what? Complete asset life key we don't give to any one person. Okay. So what are the five? First one, risk reward. Tell the answer. Risk reward. Risk reward will be in the hands of lessee. Risk reward in the hands of lessor. 1 point. Second, obsolescence. Risk is with the lessee. Risk is with the lessor. Next, cancellation. Non-cancelable, cancelable. Next, lessor do not bear the cost. Lessor bears the cost. Full payout means what? Entire asset will be fully paid out in the hands of lessee only. Here it will not happen. That's it. Done. Mark it important. I told na, lease la one question will come in exam this time. Okay. Next. What is the concept of close-ended and open-ended lease? Close-ended and open-ended lease. Sir, what is close-ended and open-ended? Close-ended means agreement will close the asset. Sir, I didn't understand. See, you are the lessor. You purchased an asset. I am the lessee. Okay. I took asset on lease from you. 10 years is the life. 10 years I only used. I paid all the amounts, lease rentals also to you. Ante total asset cost you recovered from me or not? At the end of lease period, I will become the owner. Lessee becomes the owner. Okay. If lessee must become owner, we call it close-ended. If lessee will be given an option. If you want, you can have ownership, or if you want, you can give back that asset back. That we call it an open-ended lease. Close-ended means asset get transferred to the lessor at the end of the lease. Okay, lessor means what? Lessor will take back that asset again at the end of the lease period. Means close-ended means who purchased asset? Lessor. Lessee used for 10 years. After that, lessee will must give back to the lessor. Lessor will again take back that asset. This is called as a close-ended. Okay. Next. So lessor being the legal owner will bear everything after that. But in case of open-ended, lessee has an option of purchasing the assets. So in simple words, tell me what to do. Close-ended means once the lease period is completed, lessee must give the asset back to lessor, and lessor will purchase back that particular asset from him. Over. But in case of a open-ended, lessee will be given an option. If you want, he can buy that asset and he can take with him. Next. What is a leveraged lease? Okay, what is a leveraged lease? Main elements. Okay, what is this? Let us understand. See here. There are three parties in a leveraged lease. A, B, C. A is a lessor. B is a lessee. C is a lender. Okay, listen. Lessor gave rupees 100 lakhs worth asset to B, plant and machinery to B. And A has to give asset to B means first A should have he purchased from some market by taking loan from C. Loan rupees 30 lakh. Loan rupee 30 lakh. Means own money is how much? 70 lakh. Loan money is how much? 30 lakh. Total 100 lakhs he purchased. Okay. Now what B will do? B will be paying A lease rentals. In this lease rentals, they will pay some part as interest and principal, which we call as a EMI. Balance will be taken by A. This is leveraged lease. Leveraged lease means a financial leverage. Loan will be involved. Means instead of two parties involved, three parties will be involved. But the most important feature shall I tell you? Okay. So what is this? What is the most important striking feature? See, who took loan? A took loan. From whom? From C. Okay, na? How much? 30 lakh. What is the security? Asset is security. That asset which was purchased, the plant and machinery will be kept as a security. Means now two people are interested in that asset. Number one, A. Number two, C. B anyway is holding the asset. Na? Other than B, there are two persons interested in that asset. C is interested as a security. A is interested as a owner of that particular asset. Understood? So, under this lease, third party is involved beside lessor and lessee. Means there are three parties involved. Lessor, lessee and a third party being a lender. Lessor borrow a part of purchase cost, say 80%. Example 80, I have given 30% borrowed of the asset from a third party. The asset so purchased is held as a security. If you remove these points and write exam answers, they don't give marks. That's why I'm stressing on all the issues clearly. Number one, in a leverage lease, there are three parties involved. Lessor, lessee, lender. Okay, lessor will borrow money and purchase the asset and then gives on lease. Number two, asset purchased will be kept as a security. Number three, lender is paid off from the lease rentals directly by lessee. Okay, so lender will be paid off from the lease rentals directly by the lessee. Means lessee, instead of paying to lessor, to the extent of loan EMI, he will directly pay to whom? The third party. To the third party. So the lender is paid off from the lease rentals directly by the lessee, and the surplus after meeting the claims of the lender goes to the lessor. Means total lease rental is, say for example, 5 lakh. 5 lakh, 1,50,000 I have to pay to the lender. I will pay. Balance of 3,50,000 directly I will pay to the lessor. Lessor is entitled to depreciation allowance. Over. Very, very important. Leveraged lease. Next one. Finance lease. Classification of finance lease. Hey, just now I said na, tax oriented lease, lessor will claim depreciation. Same point. Okay. First, leveraged lease already we completed, so I don't want to discuss again. So types of finance lease na, there are 3 types of finance lease. What is that? Tax oriented lease, leveraged lease already completed, and the third one will be sale and lease back. Sale and lease back name is clear. I will first purchase an asset. Sell it to someone, and again take it on lease. I call it sale and lease back. So you have in lease accounting AS 19. It is an arrangement under which entity sells the asset to another party. Sell means what? First they have to purchase to sell. They will purchase, sell to someone, and simultaneously takes it back from the other party under a lease agreement. That's it. Over. Leveraged lease, just now I told you, lessor borrow substantial amount from the lender to purchase the asset. Okay. So it's a tripartite agreement. Tripartite means what? 3 persons are involved. Okay. In case of default of payment of lease rental by lessee, lessor is not liable to make any loan repayment to lender. Instead, lessor, the lender has to take appropriate steps to recover loan installments due to the loan purchase on leased asset. Simply to tell, lessee will have an obligation to repay that loan amount to the outsider, being a lender. Lessor has no risk. Okay. Lessor is not liable to make loan repayment to the lender. That's why what we said, one of the most important striking feature of leveraged lease is whenever lease rentals have to be paid, lessee has to pay the lease rental to lender. Balance amount will be paid to the lessor. Okay, lessee, whenever yearly he has to pay, first pay the yearly installment to the lender. Balance amount, if any in excess surplus is there, that you pay to me. So if any default happened to lender, that is because of lessee's default, not the lessor default. So lessor will not become liable. Okay. Next. It's a complicated arrangement, normally entered in case of very high value transactions. Now, tax oriented lease. Just now I told you, tax oriented lease is a finance lease. If as per agreement, depreciation can be claimed by, lessee, okay, then it is not a tax oriented lease. If depreciation by agreement is claimed by lessor, we call it as a tax oriented lease. Because whenever depreciation I claim, I will get a tax saving. Tax saving is nothing but an inflow. Okay. So therefore, in finance lease, first tax oriented lease is a finance lease. Risk and reward and ownership are substantially transferred to lessee. Okay. In a finance lease, if lessor is considered as the owner of the asset for claiming tax benefit of depreciation, then finance lease is considered as a tax oriented lease. And in simple language, how to understand? If lessor claims the benefit of, tax oriented lease or depreciation on the asset and tax saving on that, we call it tax oriented lease. Deduction of depreciation from lease rental reduces the profit of lessor, which is then subjected to tax. In other words, depreciation reduces tax burden. Depreciation is a non-cash expenditure that results in tax saving. Up to here, you need to write here. Next, if in the place of lessor, lessee is entitled to claim depreciation, then it is not a tax-oriented lease. Okay, that's it. These are all the important points you need to remember in classification of finance lease. Next one, factoring and bills discounting. Factoring means selling our debts to some other person to recover on a commission basis. Okay, for example, our bad debts are increasing day by day. Business say I should do, recovery of bad debts I should do. Therefore, we will sell the bad debts to another outside agency. They will recollect and give us, from that we will pay commission to them. That concept we call factoring. So, factoring. Factoring is called as invoice factoring. Invoice means what? Sale invoice. Debtors. Debtors will be sent. Bills discounting is known as invoice discounting. This invoice factoring and invoice discounting. Next, in factoring, parties are known as client, factor, debtor. Client, factor, debtor. See, company made credit sale. Company made credit sale. Okay. There is a factoring agency, also called as a factor. Who approaches them? Company approaches them. They will tell, Ayya, Babu, Chitti, Khanna, so many idiots are there as a debtors on my balance sheet, recollect from them. So there is a debtor. Company is what? Client to factor. Therefore, they call client, which is a company, factor, factoring agency, debtor. Bills discounting, there are three people. One is the drawer, drawee, payee. Drawer, drawee, and payee. Drawer, person who writes the bill. Drawee, person who has obligation to pay. Payee, person who is ultimately receiving it. Okay, bills discounting means what? Bills discounting means even before maturity date, we will go to a bank and get our money. So we have an obligation to pay later. So factoring is a sort of management of book debts. Book debt means what? Debtors. Bills discounting is a sort of borrowing from commercial banks. For factoring, there is no specific act, but for discounting, Negotiable Instruments Act is there. This also completed. So we completed from 22, all the answers have been covered and completed. So next one, venture capital financing. Okay, venture capital financing. Venture capital financing, see, first listen carefully what is a venture capital financing. There are so many companies where people are having mind, lot of intellect is there, but they don't have money. And with that intellect, if they start a business can be either a success or it can also become a circus. No one can give guarantee when it comes to business. Business like anything can happen. So we are not exactly telling that definitely profits will arise. Profits may come or may not come. Understood? So at nutshell, whenever business is done, profit may come, loss may come. But whenever there is a new venture, there is a more risk of failure only than a risk of success. Because in recent trends also, if you see, okay, Niti Aayog has released a research report. 92% of the startups in India are a utter failure in India. Means what? 92% at least, for example, 100 startups came. 92 are utter failure. 8 are becoming super successful. A failure 92 minimum 50 or 60 venture capital is also there. And those who invested in that, they lost their money or not. It's a high risk projects. Means what? New ventures, whenever people start, okay, new venture, it's like a producer to a new movie. Okay, unknown director, unknown star cast, or unknown cast to the movie. Producer is putting money on that, means how much risk he is taking? 100% only 3-4% probability is there that it will be a super duper hit and he will get back his money. Correct? Say ade venture capital. Venture capital financing, it's an easy word. VCF people will tell, but it's a venture, new venture. For that they require capital, financed through another person. Do you know another danger of a venture capital? Generally, I'm not telling always, generally, venture capital financiers will go for equity shares. Sir, why sir they don't give debt? Reason, I will tell you 2 reasons. Venture capital, generally they can go by debt also, but mostly they will go by equity because of one good reason. For example, you have brain, I have money, both mergena, success will come. Therefore, what I will do, I will think like this. If I really promote this fellow, if I really push this person towards his goals, he will do successful business. I will put money. Equity shares I will invest. Company grow na, that will become my company only na. Later, if I can go for IPO or if I can sell my company to someone, I will get a more value. Therefore, seeing that return, people are ready to take a risk of becoming a venture financiers. Okay. Now listen to the concept. The term venture capital refers to capital investment made in a business or industrial enterprise which carry risk and insecurity. Risk means what? I will put the money. Insecurity means what? I don't give any guarantee that money will be returned back. There is no guarantee. Success can be there, failure can be there. Insecurity. And probability of business hazards. Capital investment may assume the form of either equity or debt or both. Okay. Generally equity, maybe sometimes they can go by debt. Mainly equity. The risk associated with the enterprise could be so high as to entail total loss. That's what we discussed. How much risk is involved in venture? A venture can become so much a flop, whatever money you kept will be lost. Next, this point you need to write in exam first. For this, they will give you 2 marks. Next to 2 marks, this paragraph you need to write. Venture, this point not required. Okay. Venture capital thus implies an investment in form of equity. I told you, mainly equity for high risk projects with an expectation of higher profits. Investments are made through private placement. Means what? Only to select group. For example, Kaushik Mukesh is there. Okay. Kaushik Mukesh is there or someone is there. Select group of people will become venture financiers. Okay. To us only they will issue, not to public. So it's a private placement with expectation of risk of total loss or huge return. Either you will get full loss or you will get super duper returns. High technology industry is more attractive to venture capital. High technology means IT companies. Okay. Main objects of investing equity is to get high capital profit at saturation stage. That's what we said. When company really, I believed in a person, I believed in his conviction, I believed in his mission and vision. I thought like this. This fellow, I can believe him. He's having a very good business knowledge, but money not there. I will put money, he will put the brain. It will become super success. Anyway, equity shares belong to me. If company becomes successful at a saturation stage, I will get a huge capital profit. What is my capital profit? I will invest at 10 rupee par value. I will sell at 5,000 rupee, 6,000 rupee. Huge capital gain I will get. Okay. These are the 2 points you need to remember. For that, 4 marks. Next, what are the methods of venture capital financing? Venture capital financing refers to financing and funding of small scale enterprises and high technology and risky ventures. What are the methods? First one, equity financing. Just now we discussed that venture capital undertaking generally requires the funds for a longer period, but may not be able to provide returns to the investor during initial stages. Therefore, venture capital finance is generally provided by way of, that's what I told. Since a venture should become successful, minimum 6-7 years it will take. 6-7 years minimum means equity is better. Okay, equity is better. So initial stages, they are not able to provide any returns. Therefore, they will issue equity share capital. Equity contribution of venture capital does not exceed 14% of the total equity capital. Okay, so that effective control and ownership will be vested with the entrepreneur. See, venture capital should not become a scam at the end of the day. Then Reliance Ambani will do that only. Therefore, what they said, venture capital, total capital 100%. I started my company. I should have minimum 51% control. You will have 49% control. Does not exceed. It can be 20-30 also. Maximum 49. So venture capital can have 49%. Original entrepreneur will have 51%. See, at the end of the day, you should not throw me out now for giving ideas. That's why. Conditional loan. This is another type. A conditional loan is repayable in the form of royalty after venture is able to generate sales. See, I will put money first. Okay, I am a venture capital person. I will put money, start the business. Once it becomes successful, you do sales. On that sales, you pay royalty to me. No interest is paid on such loans. You will give me loan. I will start venture. Success came. Royalty you pay on the sale. Means 8% royalty. Means what? Whenever you make any sale, in that 8% should come to me. In India, venture capital charges a royalty ranging between 2 to 15. That's why I said 8%. Actually depends on other factors of the venture, such as gestation period, cash flow patterns, etc. Okay. Next. Some people, instead of royalty, can ask a higher interest rate, something above 20% like that they can ask. Okay. This is called as conditional loan. Income note. Sir, first one is understandable. Okay. So it's a combination of equity and conditional loan type. Okay. More conventional loan and conditional loan. Entrepreneur has to pay both interest and royalty on sales, but substantially low rates. Normally, what is the general royalty? 2 to 15. Interest rate more than 20. But here, both you pay. To some extent, you pay royalty on sales. Why? Reason is very clear. Royalty comes at the sale amount. Means every month I can collect it. Every month I can collect. Interest will be paid at regular intervals at the end of the year. Therefore, I will ask both. Such that I will have recurring income venture capitalist will have recurring income as well as a yearly income. So IDBS venture capital firm provides, this is example. So mainly you need to read up to here. So it is a hybrid security combining conventional loan and conditional loan. It has to pay both interest and royalty, but at substantially lower rates. Participating debentures. Such security carry charges in 3 phases. In startup phase, no interest is charged. Proper debenture I will issue. During beginning phase, 1 to 4 years like that, no interest. Next stage, low interest will be paid. Once you pick up and business becomes successful, a high rate of interest will be required to be paid. Okay, next one. Factors that venture capitalists should consider before financing any risky project. Now think from the venture capitalist point of view. What factors you need to consider? See, at the end of the day, you are not believing in you. You are believing in the management and mind of another person giving the money. Therefore, quality of management is the first thing. You should have high level of commitment in the project. Next, management is good. What about technical ability? So technical ability of the team is also vital. And two things should be perfect. Management people should be perfect and highly committed. Operations also team should be perfect. Okay. So technical ability. So first one, management ability, technical ability. Next one, I have management ability, I have technical ability. Product will come out, but what is the guarantee that this product is saleable? Therefore, technical feasibility of the new product. Easy way to remember here. You are leaving theory and going to exam. First one, quality of management. Next one, technical ability. And management ability, technical ability. Next one, feasibility, technical feasibility of the product or service that you are giving. Next. Since the risk involved in investing in the company is quite high, venture capitalists should ensure that prospects for future profit compensate for risk. Means what? Not just a profit. Your profit should match with the risk that I am taking. So matching between risk and reward. Research must be carried out to ensure that there is a market for the new product. This is something similar to technical feasibility. You can write the point after that. So you will remember. So management quality and management ability. Technical ability. After that, technical ability, technical feasibility of the product, and research should be done whether the product is having a market. Next one, since the risk involved is very high, future profit should compensate the risk taken. Venture capitalist himself should have capacity to bear the risk. So first you should absorb loss. You should have ability to absorb the loss. Then only come into venture capital. Okay. Next. That's it. Those are the main things here. 6 points. At least you need to write these 6 points. You remember. Okay. Easy points. Next. Very, 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 very important. Next question. Seed capital assistance. This is similar to venture capital, but seed capital assistance is given by IDBI only. Okay. Infrastructure development. So for them, that particular IDBI bank is only giving seed capital assistance. Do you know what is the seed capital assistance? Name only clear. Seed. I am an entrepreneur, qualified entrepreneur, technically sound. I came from IIT. I have a very good knowledge on some technical ability. I have given a research report to IDBI. IDBI said that you do one thing. You do the business. I will give you capital assistance. Venture capitalist type, but IDBI only will do. Seed capital assistance has been designed by IDBI for professionally or technically qualified entrepreneurs. All the projects eligible for financial assistance from IDBI, directly or indirectly through refinance, are eligible under this scheme. Okay. So simply, if IDBI can sanction loan to a company, to all those seed capital assistance is available. Project cost, to give a seed capital assistance, project cost should not exceed rupees 2 crore. Okay. And maximum seed capital assistance, okay, should not exceed 50% of promoter's contribution or rupees 15 lakh, whichever is lower. So 3 points I said now. Seed capital assistance is designed by IDBI for professionally qualified and technical entrepreneurs. Number 2, project cost should not exceed 2 crore. Point 3, maximum seed capital assistance should not exceed 50% of the promoter's contribution or rupees 15 lakhs, whichever is lower. Promoter contribution is 1 crore. 1 crore into 50%, 50 lakhs. 50 lakhs or 15 lakhs, whichever is lower, 15 lakhs. So seed capitalization is restricted to 15. Promoter's contribution is at 10 lakhs. 10 lakhs into 50%, 5 lakh, or 15 lakhs, whichever is lower, 5 lakhs. Okay. Seed cap assistance is a interest free but carry a security charge of 1% per annum for first 5 years and increasing rate thereafter. Means interest free but carry security charge. Means what? Has a security charge. They don't call it interest, they call it security charge. For security of money given, we will be asking you some interest. Okay, at the rate of how much percent? 1% per annum for the first 5 years. Later slowly they will increase. Okay. Next, what is the next one? GDRs and ADRs. So these in law already we read so many times. What is a GDR and what is a ADR? Simply GDR, name only clear. Global Depository Receipts. Indian companies will issue their shares. Okay, will issue their shares either on private placement or public offer to the people outside India. Those are called as a global depository receipts. Means Indian companies will not give shares, will give receipts through a depository outside India, which will be converted into shares. Those are called as a global depository receipts. If it is only America, we call it American depository receipts. So it's a certificate denominated in US dollars. Okay, represents a non-US companies publicly traded local currency equities and Indian company. GDRs are created when local currency shares of Indian company are delivered to depository local custodian bank against a depository bank issuing the receipts in dollars. Simply, it is issued by Indian company to a depository outside India. Okay, to a depository outside India who will issue the debentures in our currency. GDRs are traded freely in overseas market like any other dollar expressed security. Same thing if it is issued in America, traded on New York Stock Exchange or on NASDAQ, we call it American depository receipt. These two questions, just give a reading and leave. Important, I'm not telling those are not important. Important, very, very important. But already covered in law paper, na GDR's concept, that's why. IDR, Indian Depository Receipt. Same reverse concept. Company outside India, if it is issuing receipts to a depository within India, which will convert into shares of that company shares are issued to public in India, we call IDR. The concept of depository receipt mechanism, which is used to raise funds in foreign currency, has been applied in Indian capital market. We are going to issue their GDR. They are coming to India and issuing becomes IDR. Foreign companies can issue IDR to raise funds from Indian market in the same lines as Indian company uses ADRs or GDRs. That's it. Next one. What is a bridge finance? What is a bridge finance? See, I will first tell you what is the real general meaning of a bridge finance. Okay, let me explain what is a bridge finance. See, companies will go for banks for a disbursement of loans. Correct? Companies will go for term loans, bigger loans, 1,000 crore loan, 5,000 crore loan. They will go for bigger loans from the banks. Bank will tell that yes, we will give you, but lot of procedures will be there. That's what we read at the beginning of this chapter. Now, bank loans are more formal in nature. Lot of terms and conditions. So many procedures are involved. So I wanted to start a project in another 20 days. I went to a bank today and said that I want a loan, 5,000 crore. Bank said, yes, we will give you. We will give you. I said, thank you very much, give. Bank said, no, sir. I will give, but there are a lot of approvals. We need to take approval from the regional bank. Branch manager has to say yes, sir. After that, security of which asset you are putting, our legal person will come and check whether that land is really there. It will take somewhere around 35 to 40 days. I said, sir, how 35 to 40 days, sir? Not possible. I have project in another 20 days. They said, bank will tell, okay, do one thing. We will definitely give you loan in another 40-45 days, sir. Okay, but you have a project in another 10-15 days, na? In the meanwhile, to just start the project, some basic capital required, na? To that extent you take loan. That's called as a bridge finance. Bridge finance means in order to fill the gap between sanction date and actual receipt date of a loan, we can't stop the project, na? Minimum capital is required. For that, we will, to bridge that, we will take loan. That's called as a bridge finance. And again, bridge finance does not mean financing to construct bridges. No. So bridge finance refers to normally loans taken by business usually from commercial banks for a short period. When there is a pending disbursement of term loans by financial institution, normally it takes time for financial institution to finalize the procedures like security, tie-up participation, etc. However, once the loans are approved in principle, means I said na, bank said I will give loan, so loan is approved. Firms, in order not to lose a further time in starting the project, classic example, what I said is actually there. Arrange the bridge finance. Such a temporary loan is normally repaid out of proceeds of principal. The original principal loan will come after 40 days. Once the amount is received, we will first repay this bridge finance. Understood the pointer? That's a concept called as bridge finance. Next, secured premium notes. Sir, what is the secured premium notes? Secured premium notes are issued along with detachable warrants and are redeemable after 4 to 7 years. See, first, secured premium notes, life will be 4 to 7 years. These are non-convertible debentures with non-convertible debentures with warrant. Means what? If company, it's a debenture type. If loan debentures are repaid with interest, then very much okay. If they fail, warrant will now get into existence. Means what? Warrant means a power. What power I have? I can convert that into equity shares. So it will not get converted into equity shares if no default occurred. But if default occurs, immediately warrant will convert into shares. That means there is a security for you or not. That's why they call it secured premium notes. So this is a kind of NCD attached with a warrant. NCD plus means attached warrant. It was introduced by Tisco, which issued Tata Iron and Steel Company, which issued SPNs to existing shareholders. Subsequently, SPNs will be repaid. If they repay in installments, very good. The warrant attached to SPNs give the holder right to apply for and get the allotment of equity shares. So if they do not pay amount, I can convert that into equity shares. Okay. So packing credit, I'm going to make a separate video on cost of capital and capital structure chapter. Okay. See, now I am uploading this video, this particular session. I will cover the main theory 2 areas. This one and objectives and scope. Under 10 marks theory we will cover now. But another 3 marks theory is there that can come from cost of capital, capital structure. There anyway we have to read about packing credit. There I will discuss. Okay. Last concept in this area is securitization. Okay. What is securitization? Bank will give loans. Bank factoring is another type of factoring. Factoring is for debtors. This is for loans. Bank gives loans. Okay, to the borrowers. And these borrowers will become default and become NPA. Because of that, what problem will come? Bank give loans to borrowers and the borrower become NPA, non-performing asset. He will not pay. Idiot he is. That problem will come or not? Therefore, banks will sell these NPAs. Okay, sell these NPAs to a special purpose vehicle, which is called a securitization company. Okay, this securitization company will issue security receipts to investors, raise money and pay to the bank. Okay, sir, I did not understand what you said. Sir, I will explain in an easier way. Actually, for CA final, securitization is a separate chapter. 4 or 5 hours we will explain there. But what I will explain to you is, I will explain the summary of this securitization. Listen. Banks will give loans to the borrower. Okay, what? Now, this borrower became NPA. Now, bank will sell these borrowers to a SPV. This is a separate entity which will purchase all the NPAs. This SPV will pay consideration minus commission. Okay, to whom? To the bank. From where SPV is getting money? Whatever the amount of NPA you are transferring me, that much amount of bonds they will issue to qualified institutional buyers. These bonds are called as these bonds are called as security receipts or pass-through certificate or pass-through units. You can call it in any way. Tell me totally. I'm giving summary because it's a fast revision. Therefore, banks give loans to borrower. Borrower is a idiot. He became NPA, not paying. Therefore, borrowers that NPAs will be sold to a SPV. SPV will pay money to bank. At least bank will get, instead of zero, they will get some value. But how come SPV is getting money to pay banks? SPV, to the extent of NPA, issue bonds to QIB. Okay, QIB will invest. They will give money immediately. I will give to bank and I will acquire. Now the SPV problem started. SPV will appoint a person called as servicer. Okay, this fellow will recover the EMIs from the borrower. Recovery agents they are. Once the EMIs are collected, EMIs la interest portion will be there na. They will pay to the QIB bonds. They issued bonds na. On that bond interest has to be paid. From where they will pay? From the EMIs collected, I will pay interest. Principal, I will keep it with me. This is how securitization occurs. But try to understand. One borrower, multiple borrowers. There are thousands of NPAs in a bank. They will pool and bring everything into one single set, pack, make it into one set, and transfer to SPV. So bank will do three things: pooling function, packaging function, and transfer function. See now. Origination function. Okay, origination function. What is the first thing that happens in securitization? Origination means what? Loan first originated. Borrower seeks loan. Remember the diagram. From a bank. Credit worthiness of borrower is evaluated and contract is entered into. Okay, 1 point over. So bank first gives loans to the borrowers. That is step 1. Pooling function. Similar loans on receivables are clubbed together. Okay, to create an underlying pool of assets. It is transferred to special purpose vehicle. Over. Securitization function. SPV will structure and issue securities, bonds. The security carry coupon. I told now EMIs will be collected, coupon will be paid. Okay, next. These are generally sold to investors through merchant bankers. QIB, qualified institutional investor. Pension funds and mutual funds. Okay. Process of securitization is generally without recourse. Without recourse. The investors bear the credit risk and the issuer is under an obligation to pay the investors only if the cash flows are received by him from the collateral. Okay. Without recourse. Means what? Once the investor bear the credit risk. Simply to tell, SPV issued debentures to the QIB. If SPV could not collect money from the borrowers, then what will happen? I can't pay interest now. That risk will always be there. So investors bear the credit risk and the issuer is under obligation to pay the investors only if cash flows are received by him from the collateral. Means if that borrower pay me, I will pay you interest. That risk will be always involved in securitization. Advantages. What is the advantage of debt securitization? Because of doing the debt securitization, banks are selling their NPAs to some other person and they are removing the risk from the balance sheet. The asset is shifted off the balance sheet. Thus, the originator recourse to off balance sheet funding. Converts illiquid asset to liquid. Illiquid means what? NPA is a dead asset. Now it is creating a life. So first one, asset is shifted to off balance sheet. Illiquid asset is converted into liquid asset. Next one, better balance sheet management as the assets are, that is similar to point 1. Originator's credit rating enhances. Originator means what? Bank. When bank is having lesser NPAs, more credibility will be there. Okay, this is all about securitization. 99% of entire concept has been completed. Packing criteria will complete separately. Okay, so I hope everyone enjoyed this class and also got full clarity of the entire theory. Main theory completed here with this. Okay, 12 marks theory or 13 marks theory, 10 marks over. 3 marks I will cover in a separate video and I will upload. Okay, so all the very best. Thank you very much and share this video. If you find it useful, like the video. Please comment below whether it is useful for you or not. I took a lot of efforts to make the book ready for you because I compiled all questions and kept in one place. So that handwritten notes also I will be putting in my Telegram group for your reference. Okay, wa? So thank you very much. All the very best. Meet you in CA final. Hello, all the CA Inter students. Now we are going to make a quick revision of CA Inter FM theory. So in this regard, I am going to first start with our chapter number 1, scope and objectives of financial management, and you can expect a 4 to 5 marks question in coming examinations. So just in a very less span of time, we are going to revise each and every theory question in this particular area in my style. Let's start. See, what is the first question? What are the stages an entrepreneur will go through while starting a business or a venture? Simple logic. Whenever I say business, an entrepreneur will have two important decisions to take. Number one, where to get the money, where to put the money. How to get the money, how to put the money. How much to get the money, how much to put the money. Sir, what are all these? In simple, financing decision, investment decision. Okay. See, I wanted to take a home loan. Okay, now tell me, you will take loan and buy the asset, or you will first buy the asset, later take a loan? I will first take a loan and then I will buy an asset. Means first financing, next investment. Correct? Now catch point will come. Listen carefully. Though financing happens first and investment happens second, without investment ideology, financing can't happen. Shall I tell an example? Listen carefully. I went to bank. I said, give me home loan. They said, how much? No, give me home loan. Bank said, okay, sir, I will give you how much? Give home loan. Arey Muttal, I will give you how much? No, give home loan. Whatever amount you want, you give me. Like that, we can't ask na. Unless and until you have an idea about how much investment, that much of financing only we should make. And then you will make investment. So how it will be? It's a cycle. Investment ideology, financing, investment decision. Investment ideology first. Next, to that extent finance it, then make investment directly. Okay, let's understand. If you understand this way, why you will forget FM theory? Yeah? Like a fools, we are mugging up all the concepts. We don't want logic. That's why question papers are scaring us. See, stage 1, decide which assets to buy. First you target, I wanted to buy this. Okay, this cost 1 crore. So take 1 crore loan and then you buy. Decide about investment amount involved. Sir, I wanted to buy this building. Okay, stage 1 completed. Stage 2, how much is the cost of this building? That's the second stage. Next, third stage, that much amount first you need to finance. Decide about the capital that is required to run the day-to-day activity. Also called as what? Working capital. Decide about the sources of funding. Equity, debt, preference. So, first these two, next these two. Understand. Stage 1, decide what assets you wanted to buy. Okay. Second, decide about amount involved. That amount we need to get done. How much amount is involved? That is about the capital that is required. Two types of capital. Decide about amount of investment means this is the main capital required. For to run the business, every day also some capital is required, working capital. Next, from where to get that working capital, from where to get that fixed capital to invest in asset. Decide about the sources of funding, equity, debt, preference, etc. Next, what are the three key questions that are required to be answered in a business with respect to money? With respect to money in a business, there are 3 questions that are required to be answered. What are those 3? From where to get the money? Financing. From where to put the money or where to invest the money? Investment decision. After financing and investing, profits will be made. That is called as a dividend decision. So whether to distribute or not, dividend decision. So FM is concerned all about acquisition of funds. After acquisition, allocation in the assets. Next, after that, distribute the dividend. Next one. What are the various sources of procurement of funds? Okay. Now, there are so many ways of procurement. First one, equity financing. Equity shares are most reliable source of financing. Most reliable. Why most reliable? They don't leave the company. Even though they leave, another person will come and sit in their place. That's why perpetual succession exists in shares, but not in debentures and preference. Understood the point or not? Advantages. Less risky since repayment is not mandatory. Debentures, if you raise, after 10 years you have to repay. So next one. Less risky since the repayment is not mandatory. What do you mean by that? Anyway, like a debenture, like a preference share, I need not repay them after 5 years or 10 years. Buyback is optional. Na? If board wanted, they will do, or else they need not. So repayment is not mandatory. That's why company has no finance burden because of equity. Okay, that's the number one. Number two, shareholders gets the share in the growth of company. Whenever company grow, equity shares also will grow. Whenever company projects are growing, debentures will grow, but hardly they will grow by 1 rupee, 2 rupee, 3 rupee. That too because of RBI interest rates they will change, not because of performance of a company. Because debenture holders will get a fixed interest. Whether company is a failure or a success, they will get a fixed return. So company success and failure don't determine that. RBI interest rates will change the debentures value. So reality, like growth enjoyment will be there only for equity. What is the disadvantages of equity? High cost. Because they are taking a risk, there is no return guaranteed for them. When there is high risk, high return they will ask. That's why KE is always higher than all kinds of cost of capitals. No tax benefit. Yes, very important. Dividend is an appropriation out of the profits, not a charge against profit like interest. Next, dilution of ownership. Dilution of ownership. What do you mean dilute the ownership? Whenever the equity shares are increasing, earnings per share will dilute. More number of people will start deciding the company performance. So that's a good, not a good thing. So advantage, disadvantage. Next, debentures. Debentures is a debt to the company. Company takes loan not from one bank but from public. That's called as a debenture. Advantages. KD is very less, and moreover, debenture interest is a tax benefit available, and no dilution of ownership. Simply, what are the disadvantages of equity or the advantages of debt? High cost to low cost. No tax benefit, tax benefit. No dilution, no dilution. That's all. Easy. Disadvantages of debt finance. See, advantage here, disadvantage. Less risky, high risk. Repayment is not mandatory. Repayment of capital is mandatory. Okay, shareholders get growth. Here, growth will not come, and interest is mandatory whether profits are there to the company or not. Bank financing. No, sir, I don't want to go for debentures. I don't want to take from 100 persons or 1000 persons. I will take from one person. It's a bank. Commercial banks are of good support to the business entrepreneurs. What are the types of loans banks are giving? Loans. These are called as a term loans. Cash credit. Cash credit. OD balances they tell na, that is the next one. Working capital loans. Working capital loans means you should use only for daily, day-to-day working capital, not for any other purpose. So normal long-term loans, also called as a term loans. Cash credit, OD, both are similar. Okay, both are similar. Day-to-day business. Working capital is also similar. So all these three are similar with minor changes. Those anyway not applicable for your exam. I don't want to waste time. So just remember loans, cash credit, OD balances, working capital loans. Next, directly international financing. Sir, India is not a platform for me. Okay, I will go directly to the other part of the world and I will take financing. Yes, you can go. Enterprises need not depend only on domestic funding. They can also go for international markets. Most popular, foreign direct investment, foreign institutional investor, American depository receipts, global depository receipts. Angel financing. Angel financing. See, I will give you an example of what is the angel financing. Who is the angel here? Not like what you are thinking in your mind. So let us try to understand who is an angel here. Angel is an individual investor. Angel is an individual investor. Wealthy individual. Wealthy. Huge crores of money like Mukesh Ambani, etc. He is not doing that. Example I am telling. Wealthy individuals. Okay. Why people go for angel financing? Because banks are not giving them loans because they are very new into the market. See, I started my company yesterday. I went for bank loan today. Banks won't give me the loan because I don't have any past track record. But I am a very good person. I came from IIMs. I am a chartered example. I am a chartered accountant. This example actually. So I am a chartered accountant. I am a qualified company secretary. I am a qualified cost accountant. I have a huge background of financing everything, and I am trustworthy. You can believe. So I wanted to start a business. Give the loan. Bank will tell, sir, you are a good person. You are a gentleman. Nice. Everything is good. But how can I believe you? I don't know your past track record of performance. Na? So therefore, we can't give you loan. Sorry. I went to a venture capital. Venture capital means small amounts they will give. But I want a minimum 10 crore. That means I am not so small like taking money from private lenders. I am not so big like going for a bank loan. Banks not giving the loan. VCF can't give the loan. In these two cases, in middle, there is one angel called as who came like a god. That's why they call angel financing. Angel finance is a equity finance. That's a very, very important MCQ. It's not a debt finance. Angel financing is equity finance. They wanted to enjoy the growth in future. Angel investors are wealthy individuals investing in startups and expansion. They usually invest between 25 to 60%. They will only give the money. Angel financing is the last option where the company does not qualify for bank loan or too small for venture capital funding. Next one. What are the aspects to be considered for effective utilization of funds? For effective utilization of funds. Okay, let's see. So what are the aspects to be considered for effective utilization? Effective utilization, it's not utilization. Effective utilization means optimum utilization of assets. How to know? Capital budgeting. Capital budgeting, there are some techniques like capital rationing. Means what? I have limited capital of 100 rupees, but the assets available for investment are 150. There are 4 or 5 combination of assets. You have to invest in such assets, your 100 rupees in such a way, overall NPV should be higher. Okay, not just like I have 100 rupees in my pocket, there are 5 assets, total all the cost of 5 assets, invest. No, capital rationing technique you have to apply, and then you have to invest in the assets. Then I call it you are investing in the fixed assets at their optimum level. So the funds should be invested and utilized in such a way that it should utilize the fixed assets at optimum level. Next, long-term investment decision means just because of the reason that you have money today, you should not go on investing in assets unnecessarily. For example, there is a machine which is having a capacity to produce 1 lakh units in a year. 1 lakh units in a year. So my target is to produce 2 lakh units. What you have to do? 2 machines you have to purchase. Correct? Now what I am doing is I have totally 2 lakh capacity. Now what I will do? I will purchase 4 machinery and I will use for 50,000, 50,000, 50,000, 50,000. 2 lakh units I will produce. Is right? 100% wrong, because your more finance is invested in 4 assets, though 2 assets can do the same thing. So long-term investment decision should not endanger, means create a problem of your solvency. Company should not become insolvent after investing in the assets. Next one. For taking these kind of decisions, finance manager should possess knowledge in capital budgeting. Next, capital budgeting, what you will do? You will put your money in long-term assets. Sir, long-term assets, okay. I wanted to produce sugarcane juice. So sugarcane machine is required. That decision taken. But I have to buy sugarcane. I have to buy one person to work on that. Okay. So glass I have to buy. Ice I have to buy. All those will be used every day. I call it working capital. Finance manager should not only have a knowledge on the fixed capital called as a long term. Also he should have knowledge on adequate working capital required. More sugarcane purchase. Daily consumption is 1000 glasses of sugarcane juice. For that I require 500 sugarcane. I purchased 10,000. Stock will be useless. I purchased only 30. You can't cater the needs. Adequate amount of working capital only you should invest. He must also ensure that excess working capital is not blocked in the form of inventory, debtors, cash, etc. Next one. You can pause the video and listen to the concept if you want, or you can pause the video and see the document if you want. Okay, I'm first going through entire thing for your exam point of view. Mention the phases in the evolution of FM. Evolution of FM. Phase 1, traditional phase. And in 1920s, 1910, 20, 30 time, financial management is some alien subject. Normal person should not use it. It will be used in occasional events like takeovers, mergers, acquisitions, liquidation. At that time, people use it to have knowledge of financial management. Normal time of finance has no relevance at that time. Okay. FM is considered by investment bankers, lenders, and some external persons. Means like chartered accountants, normal person, you and me. Normally, financial management is not used in traditional phase. Next, transition. Slowly change is happening. At the time of making the change, day-to-day problems of finance managers are also considered. Means along with these big decisions like takeovers, mergers, expansion, liquidation, along with that, slowly day-to-day problems of finance managers, not day-to-day problems of a normal household. Company, big position of finance managers will be there. For them, they started doing ratio analysis, fund flow statements, so financial planning, fund flow analysis, etc. These used to be done through FM. Okay, modern phase today, everywhere it is still going on. Modern phase is still going on. Another 100 years it will be. So scope of finance managers and FM is greatly increased. FM started helping in every financial analysis of a company. Okay, even a small person also can do now. So FM theories that are developed during this phase, efficient market theory, CA final it will come, means whether markets are efficient or inefficient will be dependent on the candlesticks. We are not here to learn that now. So efficient market theory, capital budgeting, option valuation, CA final. So just read and leave these three words. You have to write in exam. Now time is not there. Capital budgeting na chapter is there, I said already. Option valuation means CA final of futures and options chapter is there. Derivatives, there we will see. Efficient market, CA final, security analysis chapter. So modern phase is still going on. Scope of finance managers and financial management is greatly increased during this phase. It started helping every financial analysis of a company. Example, efficient market theory, capital budgeting and options valuation. Next, tasks that are involved in financial management. Okay, easy way I will tell you. Same again, where to put the money, where to get the money, all these things are there na? Same. First, taking care as not to overinvest in fixed assets, because it will lead to financial insolvency. So invest in fixed assets, not overinvest. I told na, 1 lakh units can be produced by one machine. My target is to produce 2 lakh units. What you have to do? Invest in 2 assets. Instead of doing this, I purchased 4 assets A, B, C, D. Each one will be producing only 50,000. What is this nonsense? Unnecessarily you are over investing in the assets. Next, along with the fixed assets, working capital also is required or not? Sufficient level of working capital, that is current assets. So first point, not to over invest in fixed assets, not to over invest in current assets. Sorry, I kept in fixed assets, I kept in current assets. Current assets will go into fixed assets. Sugarcane will go into sugarcane machine. What will come out? Sugarcane juice. I will sell that. What will come? Inflow. So cash inflows and cash outflow. Next. Sir, cash inflow, cash outflow came. At the end, what will be there? Gross profit with a correct pricing you need to do. Finally, tax planning. More debt, more tax saving. Less debt, less tax saving. That's it. 5 points. What you have to write in exam? Tasks involved in FM if they ask. What you have to write? Not to overinvest in fixed assets, sufficient investment in current assets. After that, analysis ensuring the proper inflows and outflows, and having a proper gross profit with a proper pricing of the product, and finally tax planning to reduce the tax burden. Read this concept. Pause the video, read this. The next concept. One most important concept in the exam, so many times tested, agency problem and agency cost. Dead easy, listen carefully. What is this agency concept? See, agency means someone acting on behalf of another. See, there is a sole proprietor concern. Okay, what will happen in a sole proprietor concern? The person who invested, owner, will only manage the business. Partnership business, what people will do in a partnership also, partners who invested money, who are the owners, will only manage the partnership firm. This is point 1. Point 2, but in case of a company, there is a separate person who will do that. Those people are called as the managers. Simply board of directors, management. Okay. So management will be the agents to the company. Management will be agents to the company. Company is an artificial person. It cannot do anything on its own. Who should do on behalf of company? These managers has to do everything on behalf of company. Therefore, management will be doing things on behalf of the company. Therefore, management will become the agents to the company. Point number 1. Now the agency problem started. What do you mean by agency problem? In a company, owners who invested money, so-called shareholders, do not participate in the management. Then who will participate in management? Board of directors, also called as the managers, will participate. Here there comes a problem called as the agency problem. Okay. Generally, managers or management should always keep company objectives as their objective. Means what? Company goals, company aim, company focus, company objective should become their main priority. But sometimes managers will not do that way. They are human beings. They will always put their personal goals ahead of the company goals. That kind of problem is called as a agency problem. Agency problem. Because of this agency problem, company may always incur a loss also. To counter that agency problem, shareholders have to take some, or to say, counter measures. Okay, for that they need to spend some money. So the cost you are spending to tackle the agency problem is called as a agency cost. Is called as agency cost. Let us understand what is this agency cost. Before that, let us read the basics. You have to write as it is in exam. In case of sole proprietor and partnership firm, owners usually participate in the management. Point one, that's what I said. Na? Next, but in case of companies, corporates, owners do not participate, managers do that. Management means board of directors. In corporate, there is a separation of ownership and management. Okay, but in reality, and next, managers are actually expected to work in the best interest of the shareholders. But in reality, managers may put their personal goals ahead of the goals of the owners. This problem is called as a agency problem. To tackle this, shareholders have to incur some cost called as agency cost. As it is what I said, line by line they have given as an answer. 4 costs are there. I will call it boss M. What is this boss M? Bonding cost. Bonding cost means what? Consistently conducting meetings with the board of directors, creating a bonding between shareholders and board of directors, saying that we are both our friends. Please don't do any malpractice. Do anything for our benefit. That is bonding cost. But to conduct the meetings, general meetings or board meetings, etc., lot of costs are involved. Na? Those are bonding costs. Number 2, opportunity cost. Suddenly, if any manager is removed and he left, until and unless I fill that place, there will be a management problem or not. That cost I incur is an opportunity cost. Structuring cost means what? I have to remove you if you do wrong. I have to put another person. Structure of the board of directors will change. Na? I have to give training to that fellow. He has to understand. It takes time. Structuring costs are involved. Audit committee will be there. Which committee? Audit committee. That audit committee will monitor whether board of directors are really acting for their benefit or for shareholders' benefit. For that audit committee, I need to pay sitting fees, salaries, etc. Monitoring cost. So what are the costs involved? Boss M. Bonding cost, opportunity cost, structuring cost, and finally monitoring cost. Next, addressing the agency problem. Addressing the agency problem. Okay. Debt lender's point of view. A person has given debt. A person has given debt. How he can tackle this agency problem? See, always board of directors should actually, okay, board of directors. See, what do you mean by debt lender's point of view? When money is given by the lenders, na, if it is misused by the board of directors, then who will suffer? If the company becomes insolvent, they only suffer, na. That's why in the terms and conditions, they call covenant. Covenant means the terms and conditions, agreements. When loan is given by the debt holders to the company will not use it. Company is an artificial person. These managers will use. Therefore, they will put negative terms and conditions. If company is not using it in a proper way, we will put one person as a board of director. He will monitor your company. Like that, you can threaten the board of directors. Second, how shareholders can tackle? See, by monitoring the managers. How you can put the managerial remuneration. Compensation means remuneration. You will tell to the board of directors, salary will be given only if you bring this much of profit. Means what? More salary, more profit, more salary. For that they will work. Like that they can do. Or you should clearly tell them our intention is maximize the value of shareholders' stocks. Market shares price should grow. In such a way you do your work. You should motivate them always. Employees should be designed to understand. Means from the very beginning, from a low cadre employee to the high end, everyone's focus is only one thing. Share price have to increase. When share price will increase? If sales increase. When sales will increase? If you perform well at an employee level, everything will go right. So that's the point. And effective monitoring. Next, financial management versus financial accounting. So let us understand what is the financial management and financial accounting. Accounting subject you see is a financial accounting. Whatever the subject you are reading here is a financial management. What is the difference between both of them? Seriously, listen carefully. Important question again. Sir, there are totally 11 questions in this chapter. 11 like any one question will come for 4 marks to 5 marks in exam. Again, don't break them into important, unimportant slots. Okay, everything is important. What is the difference between financial management versus financial accounting? Listen, financial accounting stops and financial management starts. Means what? Financial accounting is the input for financial management. Okay. Financial accounting considers the operational events of a company. Okay. Purchase, sale, gross profit, payments, all these it will consider. Output of financial accounting. What is the output of financial accounting? Balance sheet to profit and loss accountant, cash flow statement. All these are outputs of financial accounting. Using that balance sheet P&L, financial management, we will analyze our ratios. So financial management analyzes past and take future decisions. FM is all about what? Taking the past into consideration and analyze the future. Next. Treatment of funds. Okay. Financial accounting follow accrual basis. Means what? If something falls under that particular period, all we will consider, even though not paid. If something is receivable during that particular period, we will consider all, though not received. Classic example, prepaid expenses or outstanding expenses. Means what? Rent, 11 months paid, 1 month not paid. Even then we will put it in P&L because that rent belongs to that year. Whether or not we pay, we will consider. Understood? Next. So revenues are recognized when the sale is made, not when the amount is actually received. Okay. Credit sales, we will record actually money received. No, but we will write because we follow accrual. Expenses are recognized when they are incurred, not when they are actually paid. Okay. Now, so incomes are recognized when the sale happened. Expenses are recognized when the expenses are incurred, not when they are paid. Next one. Though the books show a profits, company may not have enough liquidity to pay its obligation. This may be because sales are on credit and amount is blocked in collectible receivables. Common sense. 100 times I might have told this in the regular FM batch. What I used to tell, sale happens, profit will come. But profit is only a number in a P&L account. Profit is not cash because I made purchases for 100 rupee. I sold it for 150. Profit is 50. I purchased for 100. I sold for 150. Complete 150 credit sale. Profit is 50. But how much cash profit? 0. You did not realize it because it's a credit sale. Cash is not yet received. So though books show profits, company may not have liquidity because money is blocked in receivables. Not collected. Collectible. We didn't collect it. On the other hand, FM follow cash basis. That's why FM will always we use cash flow, not profit. Even profits are given, we will add back depreciation and other circus feeds we will do and again bring back to the cash flow. Hence, revenue is recognized only when it is actually received. That's why we call cash inflow. And expenses are recognized only when they are actually paid. That's why we call it cash outflow. Therefore, finance manager focuses is to maintain proper liquidity and not to project profits. So, finance intention is to maintain liquidity. Cash should be there, not to project the profits. Decision making. Financial accounting is collecting and presenting the data, while financial management is targeting on planning, controlling, and decision making. Accounts, so no one can take any decision. FM, the people can make decisions. Next one. Before we read 9th and 10th, I will first discuss about 11th, expected question for September exam. Okay, expected. Why? Because I saw in one of the MTP. That's why. Not because I am expecting. Okay, MTP came, chance is there, it can come. That's all. That does not mean if expected questions I have to tell what I should tell, only this question I should tell. But what I am doing, I am completing entire chapter and lastly saying what is this importance of this question. It came in one of the recent MTP. Chance is there, it can come. Okay, let's see. Role of a finance executive. So CFO. What a CFO has to do? Financial analysis and planning and ratios analysis. Investment decision, capital budgeting. Finance and capital structure chapter. Financial resources management and risk management. So how many are there totally? He has to do 5 different kinds of responsibility. How many? 5 different kinds of responsibility. Okay, what are those? First one, financial analysis and planning, investment decisions, financing and capital structure decision, management of financial resources, means how much to invest, etc. Risk management. Next, role of finance executive comparison at a CFO. What CFO once upon a time used to do, what CFAs are now doing in the world, let us see. Previously, they used to do budgeting. Now also they are doing budgeting work. Forecasting they are also doing now. Accounting, they are no more doing accounting, they are doing management of mergers, acquisitions, big things. This one and this one, previously finance manager used to do. Now accounts department is there to do these both, accounting and preparation of financial statement. But now they are doing pricing analysis. Previously finance manager used to do filing of document. They are not doing filing, they are doing decision making now. Okay, mark this question, most important for September exam. Just a direct question will come. Final touch. Profit maximization, wealth maximization. 9 and 10 combinedly we can read and complete. Okay, let's begin. So see, concept of profit maximization. Okay, profit, you know, P&L, last element is called as a profit. Originally, more profit, more good the company is. That is the objective of financial management. Traditionally, the primary objective of the business is to earn profit. Hence, it is the objective of financial management. Okay, hence financial management has to take such kind of decisions which will maximize the profit. So how to maximize profit? More sales, that's all. The credit or cash they don't see. Okay, give everything on credit, people will buy, profits will maximize, but cash recovery will be very less. Companies in a liquidity trouble, but they don't want that. Profits has to maximize. Don't put depreciation in P&L account, that's all. Profits will gain. But showing depreciation is right, because tax saving will come. So therefore, profit maximization, when it is a motive, financial frauds also will happen. Accounting frauds will happen because their intention was to show more profits. So however, profit maximization cannot be the sole objective. If then problems will arise. So problems due to profit maximization objective. So what problems company will face if profit maximization is your objective? Number one, the term profit is vague. There is no meaning, because for me one amount is a profit, for you another profit will come, because profits are calculated on the basis of accounting assumptions. Means accounting policies. Means I will explain. If I use a FIFO in stock, closing stock, opening stock, one value will come. LIFO, one value will come. Weighted average, one value will come. Bad debts, I assumed a percentage of 5% bad debts. You assume 6%, one person assumed only 2%. Depreciation, life, I assume 10 years, you assume 7 years, another person assume 15 years. For all of us, depreciation is not same. So accounting is dependent on so many estimates, policies, assumptions, etc., because of which profit will have different meaning for different people. Next, profit maximization objective has a lot of risk involved. Okay, because more profits, more risk. Higher the profits, higher the probability of risk. If profit maximization is the only goal, then risk factor will also be ignored because it will increase. Next, profit maximization objective does not take into account the time patterns. Means time value of money is never considered in profit. Never considered in profit. Cash flows consider time value of money. See, there are two projects, project A, project B. Project A, cash flow of 1 crore for 10 years. Cash flow of 1 crore for 10 years. Profit of 20 crore after 10 years. After 10 years. So what they will do? I will get 20 crore after 10 years. Here I will get 1 crore cash flow after 10 years. They will select this, they will reject this. Why? Because 20 crore, 1 crore. But this 20 crore is the profit. Is the profit. You have to reduce the, you have to deconsider the depreciation. You have to consider a lot of assumptions, everything. Okay. Then after 10 years, you are going to receive it. This 1 crore, 1 crore, 1 crore, 1 crore for 10 years I will receive. Okay, what you will see, 1 crore, 1 crore, 1 crore, 1 crore, 1, 1, 1, 1, 10 times 10 crore. Okay, but here 20 crore. So 10 crore, 20 crore. Immediately, what is your intention? 20 crore is bigger than 10 crore. No, but this 20 crore I will not receive today. I will receive after 10 years. For the present value, if you consider, it will be somewhere around 7-8 lakhs, 7-8 crores only. But here every year I am getting 1 crore. Sometimes project A might also be better than project B. So do not consider always profits, go by cash flows. So what you need to write in exam, this underlined content is there. The term profit is vague. Profit maximization will have a lot of risk involved. Okay, it does not take into account the time patterns. Profit maximization objective is too narrow objective. It fails to consider workers, consumers, society, and ethical trade back. Profit, profit, profit. That's all. Okay. Next. Wealth maximization. Sir, what is wealth? Wealth is not about profit. Wealth is about the share value in the market. Overall value of the company depends on what? Not on profit. For example, there is a managing director. He got arrested. Is there anything to do with P&L account? No. But share prices will fall. So you should appoint such kind of MD who is ethical and having a proven standing in the society. Now, share prices are coming down because of P&L account, because of profits. No. And moreover, you should understand another point. Profits are calculated once at the end of year, 31st March. But wealth, every day we have to take care. So therefore, try to understand wealth is dependent on so many factors. One of the factors is profit, but many other factors also will influence. So shareholder value means the market value is created by considering cost benefit analysis adjusted to TVM, simply NPV, present value of benefits, present value of costs. Benefits should be measured in cash flows, not in terms of profits. Shareholders' wealth is maximized only if finance manager takes such decisions which increases the market price of the shares. Take such a kind of decision which increases market price, not increasing profits. Okay, sometimes non-financing decisions also will raise the share price. Okay, for example, company is there, non-financing decision taken, they replaced one MD, share price will rise immediately. Good managing director came. Take such kind of decisions. To maximize the shareholders' wealth, finance manager should consider the following: cash flow, not the profit, cost benefit analysis, and time value of money. Read these concepts carefully. You will definitely get a 4 to 5 marks question. You will do your best. Okay. Thank you very much. We'll meet in the next video relating to one of the another chapter, sources of finance. In that selectively 6-7 questions also we can read. First concentrate on this, a 5 marks chapter.